HeyMax, what to build next, the complete product strategy. There is a number sitting inside this company that nobody outside it has ever seen, and almost everything I am about to argue runs through it. Here is what we do know. In January of 2026, a 3-year-old Singapore company raised $11 million and told the world it had 150,000 users, $6 million of annualized revenue, and that it was issuing more than 500 million of its own miles every year. Those are company-claimed figures, announced at a fundraising moment, and I will treat them as directionally honest rather than audited. Now put two of them side by side. $6 million is about 7.7 million Singapore dollars, and 500 million max miles, valued at the company's own published redemption rate of 1.8 Singapore cents, is 9 million Singapore dollars. $9 million of promises. $7.7 million of revenue. The currency HeyMax hands out in a year is worth more than the money it takes in. I want to be careful here because there are honest explanations for that gap, and we will walk through every one of them. But I want you to hold the shape of it because the shape is the problem. In HeyMax's core business, revenue and cost are welded together. Earning another dollar of commission requires issuing another mile. Growth does not widen the margin. Growth scales a thin, fixed spread, and the competitive pressure in this category always runs the same direction, which is toward giving more back. If you want to know where that road ends, look at ShopBack, the largest company in the neighborhood. 60 million users, $129.4 million of revenue, down 2.8% year-on-year, an operating loss of $23.1 million, and total equity of negative $230 million. Scale did not fix it. Scale is not the answer. So the question this book asks is not how HeyMax gets more users. It is this: what can HeyMax sell that does not consume a max mile? I call that decoupled revenue, and it is the single axis I will judge every idea against. Now, the ground rules, because you should know what kind of document this is. I do not work for HeyMax. Nobody commissioned this. Everything here comes from public sources, filings, press releases, help articles, sitemaps, job advertisements, and where a figure is the company's own claim, I will say so out loud. Where a number is my estimate, I will show you the arithmetic so you can break it. And where I looked for something and could not find it, I will tell you that too. Because in a company this young, the absences are often louder than the announcements. I will name 3 things I would build in order. I will name 3 I would refuse. And at the end, I will tell you exactly what would change my mind, 5 specific, checkable propositions, any one of which would force me to rewrite this. Let us start with the arithmetic, because the arithmetic is where the strategy is hiding. Chapter 1, the coupling problem. Take the average HeyMax user, not a real person, an arithmetic person built by dividing the company's own claimed numbers by each other. That person generates about 51 Singapore dollars of revenue a year. And that person receives about 3,300 max miles a year, which at the company's own published redemption floor of 1.8 cents is worth $60. $60 out, $51 in. I want to sit with that for a moment, because when I first ran it, I assumed I had made a mistake. I had not. The working is simple enough that you can check it in your head. $6 million of annualized revenue at an exchange rate of about $1.28 is 7.68 million Singapore dollars. Divide by 150,000 users, and you get $51.20 each. 500 million miles divided by 150,000 users is 3,333 miles each. Multiply by 1.8 cents, and you get $60. Both of those inputs are company-claimed. Both were announced on the same day in January 2026, so at least they are comparable to each other. Now, this cannot be the whole picture, and the ways in which it fails to be the whole picture are, I think, the entire strategic question. There are 4 honest explanations, and each one tells you something different about what kind of company this is. The first is breakage. Miles that are never redeemed cost nothing to the issuer. Every loyalty program in history has run on this. But here is the thing about HeyMax's currency: Max miles never expire. That is not an accident of design. It is a marketed promise, printed on the website, one of the 3 things that makes the currency worth holding at all. And non-expiry does not eliminate breakage. It defers it, and it hides it. A liability that never lapses is a liability that accumulates. Under the revenue accounting standards, an issuer only gets to recognize breakage when redemption becomes remote, and never expiring makes that judgment permanently harder to make. So of all the possible structures HeyMax could have chosen for its currency, it chose the one with the least breakage relief and the largest accumulating obligation. That is very good for trust. It is not good for margin. Hold that tension, because it comes back in almost every chapter. The second explanation is partner-funded miles. When Chocolate Finance hands out Max Miles on its debit card, or Atom converts its points into Max Miles, or a merchant runs a campaign, somebody is paying HeyMax for those miles, which means those miles are simultaneously a cost and a revenue. The more of that 500 million is partner-funded, the healthier this picture looks, and the more the business is really a currency wholesaler wearing a shopping app's clothes. The third is that redemption costs less than it appears. FlyAnywhere charges the user 1.8 cents a mile against any seat on any airline. What it costs HeyMax to actually deliver that seat is not published. If HeyMax buys travel at wholesale and sells it at 1.8 cents, then redemption is not a cost center at all. It is a second margin. And the fourth explanation is the least flattering and the most likely to be partly true, which is that both numbers were chosen to impress investors on the day of a Series A announcement. Notice what all 4 have in common. Every single one of them turns on a price that HeyMax has never published, what a Max Mile actually costs it, and what a Max Mile actually sells for. I am going to come back to that number in Chapter 3, and I am going to call it the unpublished number, because it decides everything. But step back from the detail, because the shape matters more than the digits. Strip HeyMax down and the core business looks like this. A merchant pays a commission. HeyMax keeps some of it and converts the rest into Max Miles for the shopper who generated it. The miles are the cost of acquiring and keeping that shopper. Revenue and cost are coupled, welded together. You cannot earn more of the first without issuing more of the second. And that means growth does not improve the unit economics. Growth scales a fixed spread. 10 times the users is 10 times the revenue and 10 times the miles, and the gap between them stays exactly as wide as it was. Now, if you have spent any time around consumer internet businesses, your instinct at this point is that scale fixes everything eventually. Fixed costs get spread. Buying power improves, the flywheel spins. So let me show you what happens when a company in this exact category actually achieves scale. ShopBack, founded 2014, Singapore, the biggest cashback platform in Southeast Asia, 60 million users, 13 markets, 20,000 merchant partners. It is, by any measure, the version of this business that won. In the financial year to March 2025, ShopBack reported revenue of $129.4 million, and that was down 2.8% on the year before. It reported an operating loss of $23.1 million. It did report a net profit of $208.4 million, which sounds spectacular until you look at where it came from, which was $231.9 million of net finance income from fair value adjustments on preference shares. That is an accounting event, not a business. Underneath it, the core operation lost money. Total equity was negative $230 million. 60 million users, and the core business does not pay. I want to be fair to ShopBack, because the more recent picture is better. In the 12 months to March 2026, the company reported revenue growth above 30% and 6 consecutive quarters of positive adjusted earnings, and there is talk of a listing in 2027. It got there by cutting 195 people, 24% of the company, in March 2024, and by abandoning the buy now, pay later business it had bought 2.5 years earlier. Its chief executive described that episode as the mistake of pursuing too many directions at once. Remember that sentence. It is going to be relevant when we start proposing new products. But the lesson stands, and it is the load-bearing lesson of this whole book. The category leader, with 400 times HeyMax's user count, could not make the coupled model pay on its own terms. It got to profitability by cutting costs and exiting a product line, not by discovering that commission-funded cashback becomes a good business at 60 million users. So if more users is not the answer, what is? The answer is a different kind of revenue. Money that arrives without a mile going out the other side. I am going to call it decoupled revenue for the rest of this book, and I want to give you the 3 grades of it now because they are the vocabulary for everything that follows. Fully decoupled is money that arrives with no mile issued against it at all, a membership fee, a software license, a commission on a hotel booking, advertising, data. Spread widening is when a mile is issued, but HeyMax captures a bigger gap between what it sold that mile for and what redeeming it will cost. Selling the currency wholesale sits here. So does owning the redemption supply chain. And coupled is simply more of the same. Every marginal dollar buys a marginal mile. I will tell you now that most ideas that begin with the words expand into live in this third category. Here is what makes me confident this framing is right rather than merely tidy. HeyMax already built 4 decoupled revenue lines, 10 credit card application pages, all of them HSBC and CD, earning a referral fee when somebody applies, 13 points purchase pages, earning a commission when somebody buys miles from an airline, a paid membership, and an entire business-to-business offering with 4 named products on it. None of those were the headline. Every one of them is the tell. They know, the question is what they do about it. Chapter 2, what the airlines already know. In the spring of 2020, the planes stopped flying, and the airlines needed money in a hurry. They had, it turned out, one asset that lenders still wanted. Not the aircraft, nobody wanted aircraft in 2020. Not the routes, not the slots, not the terminals. What the lenders wanted was the frequent flyer program. And so, to borrow against them, United Airlines and American Airlines did something they had spent 40 years refusing to do. They opened the books on their loyalty programs and published the economics in full. I have read a lot of documents in the course of this series. The United Mileage Plus investor presentation, filed with the American Securities Regulator in June of 2020, is the single most useful thing I have ever found on how a loyalty currency actually makes money. It is 53 pages, and slide 11 is worth the whole thing. Here is the transaction United put in writing. A customer spends $10,000 with a partner, a bank, say, and earns 15,000 miles. The partner buys those 15,000 miles from Mileage Plus at 2 US cents each. That is $300 of revenue. Later, the customer redeems the 15,000 miles for a United flight, and Mileage Plus buys that seat from United Airlines at 1 US cent per mile. That is $150 of cost. And then United wrote the punchline into the slide itself, quote, for a 50% profit. Sell at 2 cents, fulfill at 1, keep half. That is the benchmark. That is what a mature loyalty currency does, and every company in this business is being measured against it, whether it knows it or not. But the number that genuinely stopped me was somewhere else in the same document. In 2019, Mileage Plus collected $5.3 billion from selling miles. Its total operating expense, excluding depreciation, was $110 million. $110 million to run a $5.3 billion collection machine, 2.1%. Once a loyalty currency exists, once the partners are signed and the software is written and the members are enrolled, it costs almost nothing to run. That is the prize. That is why everybody wants to be in this business. Earnings of $1.8 billion, a margin of 34%, and a detail I want you to notice because it becomes the argument of this entire book. 71% of the money Mileage Plus collected in 2019 came from third parties, not from United, from banks and hotels and car hire firms and everyone else buying miles wholesale. The airline was the smaller customer of its own loyalty program. American Airlines filed its version the following March, and it is, if anything, more useful because American published the full cash waterfall. In 2019, AAdvantage collected $5.9 billion. It paid out $2.6 billion to fulfill redemptions, 44.6%. It spent $130 million on operating expenses, 2.2%, almost exactly United's figure. And it kept $3.1 billion of net cash from operations, 53%. American also published something the industry had always treated as a trade secret. On contract structure, the deck says simply, purchase price per mile negotiated at the partner level. There is no single price for a mile. There is a price for each partner, and the strong ones pay less. And then American did the thing I am most grateful for. It published a three-way comparison of itself, Delta and United, side by side. AAdvantage collected $5.9 billion and kept $3.1. Delta SkyMiles collected $6.1 and kept $2.4. United Mileage Plus collected $5.3 and kept $2.3. Margins of 53%, 39%, and 44%. Third-party share of 74%, 68%, and 71%. So carry these forward, because they are the yardstick for everything that follows. A mature loyalty currency runs at a cash margin somewhere between 39% and 53%. It spends about 2% of collections running itself, and roughly 7/10 of its money comes from somebody other than the company whose name is on the aircraft. There is one more figure from United that I think about more than any of the others, and it is not a margin. It is a ratio. United disclosed its earn-to-burn ratio, miles issued divided by miles redeemed, for 6 consecutive years. 129%, 125, 119, 118, 122. 123. Structurally, about 1.2 miles are issued for every one that comes back. That gap is breakage, stated as a ratio, and it is remarkably stable across recessions and expansions alike. United also noted that during the 2008 financial crisis, its airline revenue fell 19%, while the loyalty program's revenue fell too. Which is why, when United went to borrow against Mileage Plus, it raised $6.8 billion. And American, going to the same well, asked for $7.5 billion and was given $10. The market decided these programs were worth more than the airlines that owned them, and it was probably right. Now, everything I have just described is a business HeyMax cannot simply become. It does not have 100 million members or 40 years of contracts. But the structure is instructive in a way that the scale is not, and there is one more disclosure I want to put in front of you, because it is the hinge of this book. It comes from Delta's most recent annual report, filed in February of 2026. Delta disclosed that American Express paid it $8.2 billion in 2025 in connection with the SkyMiles program, up 11%. Expected to reach $10 billion, it is the largest single check in the history of consumer loyalty. But Delta also disclosed how much of that money went into the deferred revenue account as miles earned, and the answer was $4.892 billion. $8 billion came in from loyalty marketing agreements. $4.9 billion was recognized as miles owed. So what is the rest? Delta tells you there is a separate line inside its other revenue called Loyalty Program, and in 2025 it was $3.362 billion. That is brand licensing. That is the fee American Express pays for the right to put the Delta name on a piece of metal. That is lounge access and priority boarding and waived bag fees. Do the division. Roughly 42% of the largest loyalty check on Earth is not a mile at all. And here is why that matters more than any other number in this book. A mile is a liability. When Delta books a mile, it owes somebody a seat, but a brand license is not a liability. Delta recognizes it on receipt at very close to pure margin, and it never has to fly anybody anywhere to discharge it. The biggest loyalty program in the world solved the coupling problem decades ago. It solved it by selling something alongside the currency that costs nothing to deliver. And then it published exactly how, in a document anyone can download. That is the model, not the scale, the shape. Sell the currency, yes, but sell something next to the currency that does not come out of your own inventory. Which brings us to the obvious question, and to the number HeyMax has never printed. If a United mile sells for 2 cents wholesale and costs 1 to fulfill, what does a Max mile sell for, and what does a Max mile cost? Chapter 3, the unpublished number. You can buy Max miles today for 1.25 Singapore cents. You can redeem them at 1.8. And if you want them before you have earned them, HeyMax will lend them to you at somewhere between 2.3 and 3 cents. 3 prices for the same unit, all published, all live at the same time, all set by the same company. What you cannot find anywhere, not in a press release, not in a help article, not in 5,206 pages of website, is the one price that actually determines whether this business works. What does a partner pay HeyMax for a Max mile? I want to build the latter properly, because once you see it laid out, the strategy stops being a matter of opinion. Start with the buy side. In March of 2026, you could buy Max miles directly at 2 cents each. In April, through Chocolate Finance, the price came down to 1.6 cents. And from the 1st of September 2026 through the end of November, Chocolate is running a promotion called Miles for Returns that prices them at 1.25 cents, 80 miles for every Singapore dollar of returns on your balance. On the 1st of December, that reverts to 1.6. Now the sell side. FlyAnywhere, HeyMax's own redemption engine, will take your miles against any seat on any airline with no blackout dates at roughly 1.8 cents each. So there it is in public on the company's own surfaces. Buy at 1.25, redeem at 1.8. That is a spread of about 44%, and it is the single most attractive fact about this business. But I have to be honest about what that spread really is, because it is easy to get excited and wrong. The 1.25 cent price is promotional, it runs for 3 months, and it is funded by a partner. Chocolate Finance is paying for the customer acquisition, not HeyMax. At the standing rate of 1.6 cents, the same spread is about 12%, not 44%. And 12% is a normal number. It is not a moat. Then there is the third price, and it is the strangest one. HeyMax first will advance you miles at an access fee of 3 cents each at the entry tier, falling to 2.3 cents at the top. Look at that against a mile worth 1.8 cents in the company's own redemption engine, and something is obviously wrong. You are paying more for the mile than the mile is worth. The resolution is that the access fee is not a price at all. It is fully reclaimable. You get it back as you earn, which means it is a deposit and the product is a loan, and I will spend an entire chapter on that later because it changes what kind of company this is. Now, is there a number that tells us what a Max mile is genuinely worth to the people who hold them? There is, and it does not come from HeyMax. In March of 2026, HeyMax ran an uncapped 20% transfer bonus into a Core Live Limitless. Worked through to the hotel value, that put a Max mile at 3.56 Singapore cents. That is the high water mark. It is what a mile is worth when the company is buying goodwill. 4 months later, on the 1st of July 2026, HeyMax devalued the Accor transfer ratio from 1:1 down to 3:2. A 20% bonus in March, a 33% haircut in July. I do not think those are unrelated events, and I will come back to what the pattern means. But the number I keep returning to comes from somewhere else entirely, and it is the most useful benchmark in this chapter, because it tells you what Singaporeans will actually pay for a mile when nobody is subsidizing anything. There is a company called CardUp that lets you pay your rent, your tax, your insurance, and your school fees by credit card for a fee. People use it for exactly one reason: to manufacture miles. In June of 2026, CardUp raised that fee from 2.6% to 2.9%. At 2.9%, if your card earns 2 miles per dollar, you are buying miles at 1.41 cents each. If your card earns 1.1 miles per dollar, you are paying 2.56 cents. That is the market clearing price of a mile in Singapore, between roughly 1.4 and 2.5 cents. It is what thousands of people pay in cash every month with no marketing attached. And it is a ceiling. If Max miles cost meaningfully more than that, Singaporeans will simply manufacture miles somewhere else. They have the spreadsheets and they will do the arithmetic. HeyMax operates inside a corridor that somebody else defines. So let us go back to the unpublished number and reason about where it must sit. We know HeyMax issues over 500 million miles a year, and we know it books $6 million of revenue. And we established in Chapter 1 that at the redemption floor, those miles are worth about 9 million Singapore dollars against 7.7 million of revenue. That arithmetic only closes if one of two things is true. Either a large share of those miles are bought and paid for by partners, in which case the wholesale price is the revenue and HeyMax is a currency wholesaler. Or the real cost of fulfilling a mile is well below 1.8 cents, in which case redemption is a second margin and the FlyAnywhere price is a retail price, not a cost. My estimate, and I want to flag clearly that this is an estimate, built from the arithmetic above rather than from any disclosure, is that the true fulfillment cost of a Max mile sits somewhere around 1 to 1.3 Singapore cents, and that the wholesale sale price sits somewhere between 1.3 and 1.6. That would give a gross margin on the currency of roughly 20 to 30%. Compare that to United, selling at 2 US cents and fulfilling at 1, keeping 50. HeyMax's spread, if I am right, is real but roughly half as good, and it is being earned without 40 years of contracts, without 100 million members, and without an airline attached. I could not verify any of this, and I want to be completely straight with you about that. HeyMax has never published what a partner pays per Max mile, not in the Series A materials, not in the business pages, not in the help center. I looked. And here is why the absence itself is informative. The great loyalty programs published their wholesale rates the moment they needed lenders to believe in them. United published 2 cents. American published its per-partner pricing structure. Delta publishes the American Express check every year. When the number is good, you print it because the number is the argument. I am not suggesting HeyMax is hiding a bad number. A company this young has every commercial reason to keep partner pricing confidential, and its partners almost certainly insist on it. But I am saying that until that number exists in public, every valuation of this business, including mine, is a guess wrapped around an assumption. Which is why it appears at the top of my falsifier list at the end of this book. Publish that number above 1.8 cents and my entire diagnosis collapses in the best possible way. It would mean the spread is fat, the coupling problem is small, and the correct strategy is not to build anything new at all. Just sell more miles. But until somebody prints it, I have to reason from what is visible. And what is visible is a company operating in a corridor between 1.4 and 2.5 cents that has published 3 different prices for its own currency, that devalued its most generous partner 4 months after subsidizing it, and that has already quietly built 4 ways of making money that do not involve issuing a mile at all. Those 4 are sitting on a page most people have never opened. It has not been updated in 2 years. Chapter 4, the page they stopped updating. If you go to HeyMax's website and click through to the section built for businesses rather than shoppers, you find something that took me by surprise. 4 products, not vague ambitions, 4 named, described, positioned commercial offerings, with a live reference customer attached to one of them. The first is called Max Miles Loyalty, and the pitch is a single sentence that could have been lifted straight out of this book. Building loyalty programs is costly. We make it easy for you to launch one. In other words, do not build your own currency, rent ours. The named customer is SingSaver, the Singapore comparison site, which gives max miles to its own customers and, in HeyMax's words, enjoys the benefits of HeyMax's partner ecosystem. The second is affiliate marketing, with a claim that a brand can reduce its customer acquisition cost by 50%. I should say plainly that the claim sits on the page with nothing supporting it. The third is called Redemption Partner, and it is aimed at airlines and hotels. Join the world's top airlines and hotels that drive miles sales revenue by partnering with HeyMax. Read that carefully. That is not HeyMax asking to transfer miles into an airline program. That is HeyMax offering to sell an airline's own points to an audience the airline cannot reach. And the fourth is Employee Benefits, a corporate channel transforming employee perks with max miles. No named customer, no case study, just the idea sitting there. Now, there are 2 testimonials on that page, and both of them are more interesting than the products. One is from Rakuten, a senior director of publisher partnerships, describing HeyMax as playing a crucial role in his client's expansion into Asia-Pacific through what he calls seamless credit card rewards optimization and AI-powered merchant recommendations. That is one of the largest affiliate networks on Earth, describing this Singapore startup as its regional expansion vehicle. The other is from Airlo, the eSIM company, whose head of partnerships for Singapore says the relationship started as an affiliate and branched into other partnership avenues. That is the land and expand motion working, in public, with a named brand. So here is a company with 4 articulated business-to-business products, a live reference customer, and endorsements from a global affiliate network and a fast-growing travel brand. And now I have to tell you the rest. The affiliate page on that same site invites brands to reach 50,000 customers. HeyMax has claimed 150,000 members since January of 2026. The news module on the business page still leads with the $2.6 million seed round from July 2024, not the $11 million Series A. And if you go to the careers subdomain, you find a duplicate marketing page advertising 300 brands, which is staler still, against the 800 claimed at the Series A. The entire business-facing surface of this company has not been meaningfully touched in about 2 years. And it gets starker because of what is missing. I went looking for pricing. There is none a rate card, none an API and interface another company's engineers could build against, none documentation, a sandbox, webhooks, self-serve sign-up. None of it exists. I checked the sitemap for a developer path. There is no such path. Every one of those 4 products has exactly one route to purchase, and it is a contact form. I want to be careful not to sneer at this, because I think the explanation is mundane and human, and it is visible in the hiring. On the 9th of August 2026, HeyMax had precisely 2 open roles anywhere in the world: a senior product designer and a customer experience and AI specialist, both in Singapore, both posted in late July. There is no open engineering role. Not backend, not platform, not mobile, not data, not machine learning, not security. 0, for a company that raised $11 million 7 months earlier. There is no role in Japan, Taiwan, Australia, or Korea, the markets it publicly promised to enter by the end of 2026, with under 5 months left on that promise. When HeyMax entered Hong Kong, it put a named general manager in place. For these, there is nobody. There is no risk role, no credit role, no underwriting, collections, or compliance role at a company that had just launched a product that takes cash deposits and advances 1 million miles. And there is no business-to-business salesperson. None, not one, against 4 named enterprise products. Now, an absence is not proof. People get hired without public postings, and small companies do things quietly. But 4 absences in a row, all pointing the same direction, are not noise. They are an allocation decision. So put the 2 halves together, because this is the moment the whole book turns. The strategy is already written down. Somebody at HeyMax sat down, worked out that the company could sell its currency to brands, sell distribution to airlines, sell rewards into corporate benefit schemes, and sell affiliate performance to advertisers. 4 ways of making money that mostly do not require issuing a mile against a shopping commission, and they wrote it all onto a page. And then everybody went back to working on the consumer app. I do not think that was stupidity. I think it was the correct short-run allocation for a small team that had to prove consumer traction to raise a Series A, but the Series A is raised. It closed in January, and the page is still sitting there, advertising 50,000 customers to an audience that cannot buy anything from it without sending an email. There is a version of this story where that is a damning indictment. I want to argue for the other version, which is that it is the single most encouraging fact in this research, because the hard part of strategy is knowing what to sell, and they already know. What is missing is not insight. It is a rate card, an interface, and the decision to charge. Before we get to that, though, I owe you 3 funerals. Because the ideas most people would reach for first, the ones that sound obvious, that get suggested in every comment thread and every board meeting, are, on the evidence, traps. And the most seductive of them is the one that everybody, absolutely everybody, asks for first. Chapter 5, the card everybody asks for. In March of 2025, a Singapore fintech with a chocolate bar for a logo told its customers they could not have their money back. Not permanently, not maliciously. But for a few days in the second week of March, Chocolate Finance suspended its instant withdrawal feature, the one that normally let you take out up to 20,000 Singapore dollars a day, and then capped spending on its debit card at $250 per transaction, and then blocked e-wallet top-ups, because customers had worked out that topping up a wallet was a way to get their money out through the card instead. 2 days later, the cap was raised to $1,000. The company managed the run. It survived, and by August of 2026, it was buffing its earn caps again by 2 to 3 times. I want you to hold that week in your mind for the rest of this chapter, because everything else I am about to say is arithmetic, and that week is not arithmetic. That week is what happens to a rewards brand when the money does not come back on demand. Now, let me make the case for the card properly, because it deserves a fair hearing, and it is genuinely the thing users ask for most. Start with the best argument, which is that Singapore does not appear to cap interchange. In Europe, the interchange fee regulation of 2015 caps consumer debit at 0.2% of the transaction and consumer credit at 0.3%. That is 30 basis points, 30 hundredths of 1%, and it is the reason European card rewards are so thin. Australia caps too. America caps debit, but not credit. Singapore, as far as I can establish, does neither, and I want to be precise about how I established that, because the method is the finding. I went looking for Visa's published Singapore interchange schedule. The page returns a not found error. So does the consumer rates page. So does the small business page. There is not a single link containing the word interchange anywhere on Visa's Singapore homepage. MasterCard's Singapore interchange page renders the company's own page not found screen, and its sitemap returns access denied. The schemes publish interchange schedules in exactly one circumstance, where a regulator compels them to. They publish for America, Europe, the United Kingdom, Australia, and Canada. They do not publish for Singapore. That absence is consistent with an uncapped market. It is not proof of one, and I could not find a Singapore interchange rate anywhere, so I am not going to pretend to a number I do not have. But the direction is clear enough. In an uncapped market, a card that captures interchange on its users' spending is capturing something a European fintech simply cannot. And HeyMax has 150,000 claimed users who are, by construction, unusually deliberate about which card they put a transaction on. That is close to the ideal cardholder base. And in August of 2026, when HeyMax rebranded, it promoted card management from a small button in the top corner of the app to front and center of the navigation. When a company makes something a primary object in its interface, it is usually telling you where it is going. So, strong demand, favorable regulation, an ideal user base, and an interface already being rearranged around cards. That is the case. Now let me take it apart. Start with the license, because in Singapore the license is not a formality. Under the Payment Services Act, an entity issuing electronic money needs to be a payment institution, and there are two tiers. The lower tier, a standard payment institution, is capped. And the caps are, in the guidelines that took effect in October 2025, 3 million Singapore dollars of monthly transactions for any one activity type, 6 million across two or more, or $5 million of daily outstanding electronic money. $3 million a month is $36 million a year. Spread across 150,000 users, that is about $240 each, annually. Or to put it another way, 1,000 genuinely active cardholders spending $3,000 a year each would break it. Any card program that is not a toy blows through that ceiling within months, which means HeyMax would need the major payment institution license from day one. The headline capital numbers are not frightening on their own. Base capital of 250,000 Singapore dollars for a major payment institution. A security deposit of 100 to 200,000, an annual license fee of $10,000 for account issuance and electronic money issuance together. But buried in the same guidelines is a sentence that matters far more than any of those. The regulator says, as a general rule of thumb, that base capital should cover at least 6 to 12 months of the applicant's operating expenses. For a company burning what I estimate at $400,000 to $600,000 a month, 6 to 12 months of operating expenses is somewhere between $3.5 and $9 million of capital that has to sit there, doing nothing, satisfying a regulator, against $11 million raised in January. And there is a second sentence about safeguarding, which I think is the one that actually kills the idea. Customer money must be segregated with a named safeguarding institution, evidenced before you commence business. That float is not working capital. It is not yours to earn a spread on. It sits there. Now, could HeyMax avoid all of this by writing somebody else's license? Yes. That is what a sponsor bank and an issuer processor are for. So let me give you the honest arithmetic on what that stack costs, using the only company that publishes it. Marqeta processed $382 billion of volume in 2025 and booked $625 million of net revenue against it. Divide one by the other, and you get 16.3 basis points, 0.16% of every dollar of spend. Of that, about 3.9 basis points goes straight to Visa and MasterCard as network fees, and about half a basis point to the issuing banks. So 16 basis points is roughly what the processing stack costs, per dollar of spend, for the largest independent card processor in the world, at hundreds of billions of dollars of volume, with all the pricing leverage that implies. HeyMax would not get 16 basis points. A program doing under $100 million of volume sits at the top of the price card, not the bottom. 16 is a floor, not a quote. And I should add that Marqeta is overwhelmingly an American business. International was 14% of its revenue last year, so Asia-Pacific pricing is a thin slice of a thin slice. Now stack it up. You capture interchange in an uncapped market, which is genuinely attractive. Out of that you pay the network, the processor, the sponsor bank, fraud losses, disputes, and the cost of the rewards you are giving back. Because remember, the entire point of a HeyMax card is that it earns max miles, which means every dollar of interchange you win obliges you to issue miles against it. Read that sentence again. A HeyMax card does not solve the coupling problem. It is the coupling problem with a payment license attached. And here is the part I find genuinely persuasive, which is that HeyMax already runs a card business, and it is the good version. Go into the sitemap and you find 10 card application pages, all Singapore, all from exactly two issuers, HSBC and CD. HSBC Revolution Advance Live Plus Travel One, CD Rewards, Cashback, Cashback Plus, SMRT, Premier Miles, and the M1 card. They sit under a version path with numeric identifiers, which tells you it is a productized system rather than a marketing page. HeyMax distributes other people's cards and takes a referral fee. No license, no capital, no safeguarding, no fraud, no chargebacks, no credit risk. And the revenue is fully decoupled. A card application generates a fee and issues no miles at all. Around that sits a programmatic estate of roughly 430 pages, every one of them answering the question, which credit card should I use at this merchant? The top of the funnel is card recommendation. The bottom of the funnel is a card application. That is a complete, working, capital-free card business, and it is already built. Built Rewards is the cautionary tale here, the American points company that did get its card, and whose banking partner reportedly bled heavily on it before the arrangement was restructured. I could not independently verify the loss figures that circulate about that deal, so I will not quote them. What I will say is that the structural lesson survives without them. A rewards brand with a card is a rewards brand that has taken on a bank's risks while keeping a startup's balance sheet. So my answer on the card is no, and I want to be precise about why. Not because the interchange maths is bad, in Singapore it is probably rather good. Because the capital is dead, the license is slow, the float is fenced, the org has no credit function, and the revenue it produces is coupled to exactly the cost line that is already the problem. It is not impossible. It is simply the most expensive available way to learn something the affiliate line already taught them. Which brings me to the second obvious idea. If you have 150,000 engaged users and you know what they buy, surely you can sell that attention to merchants. Surely reach is worth something. There is a company that spent 8 years and $1.5 billion testing that proposition in public. Chapter 6, the Cardlytics Autopsy. In 2021, shares in a company called Cardlytics traded above $140. On the 1st of August 2026, the entire company, every share of it, was worth about $20 million. That is less than 1 year of its own gross profit. It had just executed a 1-for-10 reverse share split to avoid being delisted after receiving a deficiency notice in June. I am telling you this story in some detail because Cardlytics is the closest thing that exists to a controlled experiment on the idea that a business can be built by owning card-linked offers and monetizing reach. The experiment ran for 8 years, in public, with quarterly disclosure. And the results are unambiguous. Here is what the business does. Cardlytics runs the offers engine inside the mobile banking apps of large American and British banks, Chase, Bank of America, Wells Fargo, Lloyds. A marketer buys a campaign. Cardlytics targets it using the bank's purchase data. You see it in your banking app, you activate it, you shop, and the closed loop is measured. It is, on paper, the best version of the idea. It has more data than anyone. It has distribution into the apps that people already open every day. It reached over 200 million users. Now let me show you the waterfall, because the shape of it is the lesson. Take $100 that a marketer spends. In the 2025 financial year, $39.40 of that went straight back to the shopper as cashback. $26.70 went to the bank as its share for supplying the customers and the placement. $6.70 went on delivery costs, hosting, data processing, ad operations. What was left, the gross profit, was $27.20. 27% before a single dollar of engineering, sales, or overhead. The consumer takes more than the intermediary. The bank takes almost as much as the intermediary. Cardlytics is the thinnest party in a value chain it invented. And that is the good news, because the volumes then collapsed. Full year 2025, billings of $385 million, down 13%. Revenue of $233 million, down 16%. A net loss of $103.5 million. Accumulated deficit, the total money lost since inception, $1.4 billion. Then the second quarter of 2026, reported on the 5th of August, 4 days before I compiled this. Revenue $36.9 million, down 36% year-on-year. Monthly qualified users 185.4 million, down 17%. Cash of $28 million, against $169 million of convertible notes coming due. But the number that actually taught me something is a pairing from the year before. In 2025, Cardlytics grew its user base by 18%. Over the same period, its adjusted contribution per user fell 35%. More users, much less money per user. That single fact demolishes the premise. If reach were the scarce input in card-linked offers, growing reach 18% would grow the business. It did the opposite. The scarce input is not eyeballs. It is marketer demand, advertisers with budget who want this specific inventory, and Cardlytics could not conjure it. For scale, adjusted contribution per user for the whole of 2025 was 50 US cents. Per user, per year. In the most recent quarter, it was 11 cents. Any plan that begins with the words, "We have 150,000 engaged users," and we can monetize that attention should be stress-tested against 50 cents a year. Now the second lesson, which is about whose rails you are standing on. Cardlytics disclosed in its annual report that its top 3 bank partners accounted for more than 80% of the money it pays out as partner share. Its largest single partner exceeded 50% in some years, and the contracts carry 90-day termination provisions. On the 22nd of April 2025, Bank of America, a top 3 partner, gave notice that it would not renew. The relationship ended completely on the 16th of February 2026. Meanwhile, Chase, the largest partner of all, did something more instructive. Cardlytics wrote in its own annual report that Chase had recently and substantially increased the number of marketers subject to restrictions, that those restrictions would expand, and that this was expected to cause certain advertisers' budgets to decrease significantly. Now put that next to a separate sequence of events. In 2020, a company called Audiobook acquired Emper and merged it into a card-linking business called Fig. In 2022, JP Morgan Chase acquired Fig. And in April of 2024, Chase launched Chase Media Solutions, its own first-party retail media network, marketed as reaching 80 million American consumers. So Chase bought the card-linking technology, launched a competing network of its own, and restricted which marketers Cardlytics was allowed to serve inside Chase's app, simultaneously. That is the lesson, and it generalizes far beyond this one company. When you build on somebody else's rails, the owner of the rails sets both your inventory and your rake. And if the business turns out to be good, they will simply do it themselves. There is a final chapter to the Cardlytics story that I find almost painful. In 2021, the company spent about $856 million on acquisitions, $278 million for Dosh, a consumer offers app, and $579 million in total consideration for Bridge, a retail data business. In January 2026, it agreed to sell Bridge to PAR Technology for $27.5 million in stock. The deal closed in March. Roughly 5 cents on the dollar. And lest you think this is one badly run company rather than a structural problem, consider Fidel API. Fidel was the purest expression of card linking as infrastructure. Sell the plumbing, let others build the products. It raised $88 million from Bain Capital Ventures, CD Ventures, Excel, and others. In May of 2026, it sold its loyalty business, the platform, the customers, the partners, the people, and the brand itself, to a company called Enigmatic Smile, and kept the expense data business instead. The price was not disclosed, and I am not going to guess at it. Card linking infrastructure on its own is a feature. It is not a company. So that is the second refusal, and it is emphatic. HeyMax should not attempt to become the horizontal card-linked offers layer. Not because it would execute badly, but because the position itself is bad. The consumer takes the biggest share, the bank takes the next biggest, the Rails owner can reprice or leave on 90 days' notice, and the whole thing is worth 50 cents per user per year at the top of the cycle. And yet, there is one company in this category that has been quietly working for decades, and it is the exception that tells you exactly what the rule is. It is called Rewards Network. It is owned by a private equity firm called Towerbrook, and if you have ever earned airline miles for eating dinner, Mileage Plus Dining, A Advantage Dining, Sky Miles Dining, Hilton Honors Dining, you have used it. Essentially, every airline and hotel dining program in America runs on this one company's rails. The model is simple, and it works. Restaurants pay a commission on what enrolled members spend. Rewards Network buys the miles from the airline program and gives them to the diner. It keeps the difference. It has more than 20,000 restaurants and 25 million enrolled card members. And it has been doing this profitably since long before anyone said the words retail media network. Why does this work when Cardlytics does not? Because it is vertical, not horizontal. Cardlytics sells reach across all of commerce to any marketer who wants it, which puts it in competition with every advertising platform on earth and gives it no pricing power anywhere. Rewards Network sells one category to one type of merchant, with a reward the merchant could not buy on its own. Restaurants have thin margins, high fixed costs, and desperate need for incremental covers on a Tuesday. They will pay a real commission for a diner who would not otherwise have come. Now hold that thought and remember something from Chapter 4. HeyMax's sitemap contains 4,729 merchant pages, and they are not all big brands. They go down to individual restaurant outlets, a Korean barbecue place in a shopping center on Orchard Road, a Hokkien restaurant, a named chef's kitchen. And there is a page on the site called Dine Out. Somebody at HeyMax has already built the merchant graph for the one card-linked model that actually works. I will come back to that in Chapter 10. First, there is a third obvious idea to deal with, and it is the one that sounds most sophisticated. Stop selling to consumers and start selling the rails to banks. It is a good idea. It is 9 years too late. Chapter 7, The Ascenda Problem. 12 minutes drive from HeyMax's office in One North, in a building on Jalan Besar, sits a company that is already doing the thing everybody suggests HeyMax should pivot to. It is called Ascenda. It was founded in 2013, 9 years before HeyMax existed, under the name Caligo, and here is the part I find almost poetic. Caligo started life as a consumer hotel booking site that paid you in miles. In 2018, it stopped doing that, renamed itself, and became infrastructure. It sells the rewards engine to banks. So the pivot HeyMax is being urged to make is a path a Singapore company already walked. Forwards, nearly a decade ago, and HeyMax would be walking it backwards. Let me tell you what Ascenda actually is today, because the scale of it settles the argument fairly quickly. 255 people, 70-plus loyalty brands in its exchange network, clients in more than 40 markets. And the client list is not a list of hopefuls. It is HSBC, Standard Chartered, American Express, Capital One, Barclays, Virgin Money, ICBC, Brex, the Dutch neobank Bank, and OCBC. And then, on the 27th of April 2026, DBS. I want to let that one land properly. DBS is the largest bank in Singapore. If you are a Singaporean loyalty startup building a pitch deck for a banking client, DBS is slide 1. As of April 2026, DBS has chosen its partner, and the press release says the Hong Kong rollout came first with other DBS markets to follow. The two largest banks in HeyMax's home market are taken, and they were taken by a Singapore competitor with 255 staff and a 12-year head start. Now, if that were the whole problem, it would merely be difficult. What makes it close to impossible is what Ascenda did in October of 2024. It abolished its setup costs and its platform fees entirely. It moved to results-based pricing, charging only for content and outcomes delivered. Its chief executive framed it plainly. For many brands, rewards cost is one of the biggest expense lines on the profit and loss, and they are dissatisfied with the return. Think about what that does to a new entrant. The standard challenger move is to undercut the incumbent on license fees. You cannot undercut zero. The money in that model is made on content margin, the spread between what Ascenda pays for a mile or a hotel night and what it charges the bank. Which means a challenger is not competing on software at all. It is competing on procurement against a buyer with 70 partners worth of volume. And one more thing, which is the piece most people miss. Ascenda does not sell one bank at a time. It signed Visa for Asia Pacific in 2021 so that banks and fintechs can deploy its platform through Visa's own interfaces with minimal work. In February 2025, it signed Galileo, the card-issuing platform that powers SoFi. It sells through the networks and the processors. A challenger without a scheme relationship or a processor relationship is knocking on doors one at a time, against someone who has already been let in through the back. But here is where the chapter turns, because Ascenda is only half of the problem and the other half is worse. There is a second company that owns this rail, from the opposite end, and unlike Ascenda, it has audited accounts you can read. It used to be called Points, and it was listed in Toronto and on NASDAQ until the middle of 2022. Which means that for the points plumbing business, the actual mechanics of buying, selling, gifting, and transferring loyalty currency on behalf of airlines and hotels, there exists a filed, line-by-line profit and loss. It is the only honest set of numbers in this entire category, and I think it is the most important table in this book after the airline disclosures. In the 2021 financial year, Points did $370 million of revenue. Its gross profit was $50.8 million. That is a gross margin of 13.7%, 16.1% the year before, 16.3% the year before that. After roughly 2 decades, with 279 employees, the global incumbent in points retailing was converting $1 of transaction revenue into about 14 cents of gross profit and about 3 cents of adjusted earnings. The mechanism, in the company's own words in its filing, is this. It sells loyalty program currency directly to program members at a retail rate, while purchasing that currency at a wholesale rate from the loyalty program partner. And then comes the sentence I keep returning to. It typically provides the loyalty program partner an annual revenue guarantee for the term of the commercial agreement. In addition, it pays all credit card-related fees and assumes all credit risk. Read that again slowly, because it is the real cost of owning a rail. To get a major airline to sign, Points had to guarantee the airline a minimum annual payment. The vendor carries the working capital. The vendor carries the downside. The vendor eats the processing fees and the fraud. Any startup that wants Singapore Airlines or Cathay inventory on comparable terms should expect to be asked for comparable terms. And a company with $11 million in the bank cannot write a meaningful annual revenue guarantee to an airline. Full stop. The concentration is the third warning. In 2021, 2 loyalty program partners together accounted for 57% of Points' total revenue, and its top 10 partners produced 74% of gross profit. That is not an annuity. That is a small number of terminable contracts. Plusgrade bought Points in June 2022 for $385 million. Now look at what that price means against the accounts. $385 million on $370 million of revenue is 1.04 times revenue. On $50.8 million of gross profit, it is 7.6 times. On $12.1 million of adjusted earnings, it is 32 times. The market did not value the transaction flow. It valued the gross profit. Anyone valuing a loyalty business off the volume of currency moving through it is using the wrong denominator. And I want to put one more number beside it, because the contrast is the sharpest argument in this book. On the 1st of July 2026, Adyen completed the acquisition of Talon.one, an interface-first promotions and loyalty decisioning engine, 300 people, Berlin, for €750 million. Adyen disclosed that Talon.one was expected to reach around €60 million of annualized revenue by the end of 2026, growing 30 to 40% a year. €750 million for 60 million of annualized revenue. That is about 12.5 times revenue. So here are two loyalty companies in the same industry sold 4 years apart. One went for 1 times revenue, the other went for 12.5. The difference is not the market, and it is not the timing. The difference is the shape of the revenue. Points moved gross transaction flow at a 14% margin and carried the credit risk. Talon.1 sold software at software margins and carried none. That is the decoupling thesis, priced by acquirers in cash. Now let me finish the Points story, because it ends with a door closing. In its final filing, Points told the regulator that roughly 80% of its loyalty program partners were based in North America, Europe, or the Middle East, and that it saw substantial growth opportunities particularly in the Asia-Pacific market. The global incumbent said out loud, in a document, that Asia was its white space. 4 years later, that white space is gone. Plusgrade's partner wall now carries Singapore Airlines, Cathay Pacific, Japan Airlines, All Nippon Airways, EVA Air, Qantas, Garuda, Philippine Airlines, AirAsia, and Air India. On the financial side, it carries Capital One, Citibank, Bilt, and Mashreq. And on the 31st of March 2026, Plusgrade published a piece aimed squarely at financial institutions, launching something called Points Exchange, describing it as a fully managed network built specifically for exchange, and adding, pointedly, that unlike providers who treat transfers as one feature in a broader rewards catalog, this one is built and operated specifically for that channel. That last clause is a knife aimed at Ascenda. The two incumbents are now fighting each other over the same rail, from opposite ends, both well capitalized, both holding direct contracts with the two airlines that matter most to a Singapore rewards app. So the refusal is clear. HeyMax should not try to sell loyalty infrastructure to banks. The buyers are taken, the platform fee has been abolished, the incumbents sell through networks and processors, the rail requires revenue guarantees it cannot write, and the whole business converts $1 into 14 cents anyway. But notice what nobody in that fight is doing. Ascenda has 255 people because serving banks requires 255 people. Procurement, security review, integration, account management, the whole apparatus of enterprise selling. Plusgrade is chasing airlines and financial institutions. Neither of them has any interest in the company, with 4 employees that wants a loyalty currency, and cannot afford either of them. Nobody is serving the long tail, and the long tail is where HeyMax already has a customer. Before we get there, though, there is one more instinct to deal with, the oldest reflex in startup strategy, which is to answer a margin problem with a map. Chapter 8, just add markets. In January of 2026, HeyMax announced it would launch in Japan, Taiwan, and Australia by the end of the year. On the 9th of August 2026, 7 months later, with under 5 months remaining, I could find no launch announcement for any of the 3. And when I went looking at who had been hired to run them, I found something more telling than a missed deadline. There were exactly 2 open roles at the entire company, both in Singapore: a senior product designer and a customer experience and artificial intelligence specialist. No country manager for Japan, none for Taiwan, none for Australia. None for Korea, which appears in some of the company's own expansion talk, though not in the Series A release. Compare that with Hong Kong, the one market HeyMax has actually entered since Singapore. Hong Kong has a named general manager, David B. Wang, who carries the North Asia remit and doubles as global head of loyalty partnerships. When HeyMax genuinely enters a market, it puts a person in it. For the 3 markets it publicly promised, there is nobody. Now, the easy reading is that the timeline has slipped and the promise will not be kept. That is probably true, and I would not make much of it. Startups miss dates, and a company that raised in January and is being judged in August has barely had time to spend the money. The interesting reading is different, and it comes from the job advertisement itself. Read the senior product designer posting, and you find something that does not sound like a company about to open 3 country offices. It sounds like a company that has decided offices are the wrong unit entirely. The role is described as running a growth and expansion design lab, a small, autonomous unit with one mandate, which is to grow HeyMax's user base anywhere in the world. Its first area of ownership is called Global Activation, and the posting describes it as the entire journey from first touch to first value moment, designed to work for any user in any market from day one. And then this sentence, which is the closest thing to a stated strategy I found anywhere in 7 hours of research. This is the engine that lets HeyMax launch a country without rebuilding the product. The second area is titled One Experience, Every Market, and it asks for an adaptive design system where the product reconfigures itself around user state and market maturity. You're not designing screens per country, it says. You're designing the rules that make one product serve 100 markets. 100 markets, not 3. And then the candidate bar, which is where the philosophy shows. They want somebody who designs state machines, not screens. Somebody who is comfortable with the ambiguity of, and I am quoting, a market you can't visit. Fake door tests, concierge minimum viable products, remote unmoderated research. Put that beside the other open role, the customer experience one, which states its purpose even more baldly, building the artificial intelligence-enabled model that lets us scale into new products and markets without scaling headcount to match. The same phrase appears again in the success criteria, without a matching increase in headcount. So here is what I think is actually happening, and I think it is genuinely clever. HeyMax is not planning to enter Japan the way a company normally enters Japan, with a country manager, a business development team, a local partnership, a localization project, and a launch party. It is building a machine that opens countries as a product feature. One codebase that reconfigures itself. Support run by agents rather than headcount. Growth loops that become reusable infrastructure for the next market. And the groundwork is visible if you know where to look. Buried in that 5,000-page sitemap are city guide pages, 18 or 19 of them, and look at the weighting. Tokyo, Osaka, Fukuoka, Taipei, Melbourne, Sydney, Auckland, Christchurch. 3 cities in Japan, Taiwan's capital, 4 in Australia and New Zealand. The search engine groundwork for exactly the announced markets was laid before any human was hired to run them. Now I have to be even-handed here, because this is the chapter where I most want to be fair. The 7 market-by-market volumes that preceded this one all reached the same conclusion, and it was not about demand. Demand was never the constraint. Korea, the market that led every demand metric in the series, turned out to be the least enterable because there was nobody hungry enough to sign. The binding constraint on entering a loyalty market is finding an anchor partner, an airline, a bank, a retailer with a reason to say yes. A product-led entry does not solve that. You can launch an app in Taipei without hiring anyone in Taipei. What you cannot do without a local partner is give a Taiwanese user somewhere worthwhile to spend the currency or a reason to prefer you over the card they already have. So the honest position is this. Product-led expansion is the right version of expansion. It is cheap, it is portable, it compounds, and the alternative, a country team per country on a $13.6 million balance sheet, is not available anyway. If HeyMax can genuinely open a market for the cost of a configuration change, it should open a lot of them. But, and this is the whole point of the chapter, expansion does not fix what is broken. Go back to chapter 1. The problem is that revenue and cost are coupled. Every dollar of commission obliges a mile. Now open Japan. What happens? More users, more commission, more miles, and precisely the same spread between them. Expansion multiplies the business. It does not change its shape. A thin margin applied to 5 countries is a thin margin. If anything, early-stage market entry runs at a worse margin than the home market because you are buying users with promotional issuance before the merchant network is dense enough to fund them. There is a version of this mistake that I have watched play out repeatedly, and it goes like this. A company notices its unit economics are uncomfortable. Rather than confront the economics, it reaches for growth, new markets, new segments, new categories, because growth is legible, exciting, and easy to explain to a board. 2 years later, it has 5 times the revenue, 5 times the losses, and the same underlying problem, now spread across 5 regulatory regimes and 5 customer support languages. ShopBack's chief executive has a phrase for this that I quoted earlier and want to use again, because he earned it: the mistake of pursuing too many directions as a company. He said it in the context of writing off a buy now pay later business he had bought 2.5 years earlier, alongside cutting a quarter of his staff. So my position on markets is not no. It is, yes, cheaply as a product, and stop pretending it is the answer to the margin question. Expansion is a distribution decision wearing a strategy costume. It belongs in the plan. It does not belong at the top of it. And there is one more thing the job advertisements told me, which I think is the single most useful fact in this entire book, because it constrains every recommendation that follows. 0 open engineering roles. Not one, no backend, no platform, no mobile, no data, no machine learning, no security at a company 7 months past an $11 million raise. No risk, credit, underwriting, collections, or compliance role at a company that had just started lending its customers 1 million miles. And no business-to-business salesperson against 4 named enterprise products sitting on a page. That is not a company gearing up to sell to enterprises. That is a company betting that a small team, heavily automated, can serve an enormous number of people in an enormous number of places. Which means any recommendation I make has to pass a test that has nothing to do with whether the idea is good. It has to be shippable by 30-odd people who do not have a sales team, do not have a credit team, and are not hiring engineers. That test kills a lot of clever ideas. It also points, quite precisely, at one. Chapter 9, Selling the Currency to the Long Tail. There is a Singapore company called SingSaver. It compares credit cards and insurance policies, and when it wants to reward its customers, it does not run a points program of its own. It gives them max miles. That sentence is, I think, the most valuable asset HeyMax owns, and almost nobody has noticed it, including on the evidence of that 2-year-old business page, HeyMax. Here is why it matters. A loyalty currency is very hard to start and very easy to join. To start one, you need redemption partners, and redemption partners will not talk to you until you have members, and members will not join until you have redemption partners. Every loyalty program in history has had to break that circle, usually by being an airline first. HeyMax has already broken it. It has 24 direct partners, 16 airlines and 8 hotel and lifestyle programs, and a currency that redeems at a published rate against any seat on any airline. That took 3 years and $13.6 million. Which means HeyMax can now offer any company on Earth something that would otherwise cost them 3 years and $13 million. A real, transferable, airline-grade currency, available this quarter by integration. That is the product. It is already named on their own website, Max Miles Loyalty. With the pitch written as building loyalty programs is costly, we make it easy for you to launch one. It has a live reference customer. And it has, as far as I can determine, no price, no interface, no documentation, and no way to buy it. Let me deal with the obvious objection first, because Chapter 7 built it. Ascenda sells this to banks and has 255 people doing it. Plusgrade sells it to airlines and is owned by a pension fund. Is this not simply the losing fight again? No, and the reason is the shape of the buyer. Ascenda has 255 employees because selling to a bank requires 255 employees. There is a procurement process. There is a security review, a penetration test, a data protection assessment, a vendor onboarding questionnaire that runs to hundreds of questions. There is a 9 to 18-month sales cycle and an account manager forever afterwards. That apparatus is why the deals are large, and it is also why the smallest deal Ascenda can profitably accept is quite large. Below that line sits everybody else. The fintech with 40 employees, the e-commerce brand, the insurance comparison site, the subscription business, the neobank in its second year, the property platform, the telco reseller, the eSIM company. All of them would like to reward customers with something better than a discount code. And none of them can afford a 9-month enterprise engagement or justify building a currency from scratch. That is the long tail, and neither incumbent wants it, because neither incumbent can serve it at a price it will pay. And here is the pitch that neither of them can make at all. When a brand plugs into Ascenda, it gets a rewards engine. When a brand plugs into Max Miles, it gets a rewards engine, and it gets put in front of 150,000 people who already hold the currency, already have the app open, and are already looking for places to earn. That is not a vendor relationship. That is a two-sided network, and the second side is the part Ascenda structurally does not have, because Ascenda has no consumers of its own. It gave them up in 2018 when it stopped being Caligo. The Rakuten testimonial on HeyMax's business page is evidence this already works. A senior director at one of the world's largest affiliate networks describes HeyMax as helping his clients expand in Asia-Pacific. Airlo's head of partnerships describes a relationship that started as affiliate and branched into other avenues. That is the land and expand motion running in public with real brands. It just has no product wrapped around it and no price. So what should it cost? We have a few public anchors, and they are not encouraging for anyone selling software alone. Annex Cloud publishes a list price starting at $15,000 per feature, per year. White Label Loyalty says it is not a fit for anyone with a budget under £1,000 a month. Zeal, at the small merchant end, charges £19 a month. The category almost never publishes prices at all. I checked all of them. Which is exactly why HeyMax should. A published rate card would be a genuine differentiator in a category where everybody hides behind a contact form. And it would be more than marketing because of what Chapter 8 established. This company has no salespeople, is not hiring salespeople, and is deliberately building an organization that scales without headcount. A product that requires enterprise selling is not a product this company can ship. A product that can be bought with a credit card and an interface key is. But the software license is not where the money is, and I want to be clear about that, because it is where the analysis usually goes wrong. Ascenda abolished platform fees in 2024. You cannot build a business on a license fee in this category anymore. The money is in the currency itself, in the spread between what a partner pays HeyMax for a Max Mile and what that Max Mile eventually costs HeyMax to honor. And now we can put a shape on that because of Chapter 3 and the airline disclosures. United sold miles to partners at around 2 US cents and bought the seat back at 1 and wrote a 50% profit into the slide. That is the North American benchmark, and North American wholesale rates run somewhere between 1.4 and 2 US cents. Asia Pacific is cheaper, my estimate, from the disclosures I could find, is roughly half that, somewhere between 0.5 and 1 US cent, with Singapore Airlines' own cash-out rate of 100 miles per Singapore dollar sitting at about 0.78 US cents as the best anchor available. Translate that into Singapore currency, and the picture is this. If HeyMax acquires the partner miles, it needs at something like 0.6 to 1.3 Singapore cents, and its own redemption engine prices a Max Mile at 1.8, then the redemption side of this business carries a gross margin somewhere in the region of 40 to 65%. That is my estimate, built from published wholesale ranges rather than from any HeyMax disclosure, and I want it clearly labeled as such. But if it is even approximately right, it changes the diagnosis in a useful way. The coupling problem is real at the issuance end, where a shopping commission has to fund a mile. It is much weaker at the redemption end. Which means the single most valuable thing HeyMax can do is issue more miles that somebody else has paid cash for. That is what selling the currency is. It is not a software business with a currency attached. It is a currency business with software as the delivery mechanism. Now the warning, and it is a serious one because it has already happened. In April 2025, Atom began converting its points into max miles at about 1.6 Atom points per max mile. In May 2026, Atom changed that rate to 2.8. That is a 47% devaluation in a single step and roughly 75% cumulatively since launch. HeyMax's currency was repriced in public by somebody else, and HeyMax could do nothing about it. Think about what that means for a currency-as-a-service business. If any partner can unilaterally decide how many of its points equal a max mile, then the perceived value of max miles is set by whichever partner is currently least generous. Your currency's reputation, the thing that took 3 years to build, sits in the hands of people whose interests are not yours. So the first clause in any max miles issuance agreement has to be rate protection. A floor on the exchange rate, a notice period before any change, and a right to be removed from the partner's marketing if they breach it. That is not lawyering. That is the product. And the second clause is about what happens when a partner leaves, because points filings showed 2 partners producing 57% of revenue. Concentration is the endemic disease of this category. A long-tail strategy is partly a cure for that. 100 small partners is a much better book than 2 large ones, but only if the contracts are standard enough that 100 of them can be administered by a company of 30 people. Which brings you back, again, to self-serve. So here is the recommendation, plainly. Publish a rate card. Build an interface with real documentation and a sandbox so a competent engineer at a small company can be issuing max miles in an afternoon without ever speaking to a human. Price the miles, not the software. Write rate protection into the standard terms, and point the entire thing at the companies that Ascenda's sales team will never call. It is the highest scoring product on every axis I care about. It is decoupled because the partner pays cash. It is portable because it needs no anchor in any particular country. It is defensible because the redemption network behind it took 3 years to assemble. And critically, it is shippable by the organization that actually exists, the self-serve, automation-first, 30-person company those job advertisements describe. And the best evidence that it works is that it is already working, quietly, with SingSaver, on a page nobody has updated since 2024. There is a second place the money can come from somebody other than the shopper. It is sitting in HeyMax's own sitemap, 4,700 pages deep, and it involves dinner. Chapter 10, where the merchant pays. Somewhere in HeyMax's sitemap, among 4,729 merchant pages, there is a listing for a Korean barbecue restaurant in a shopping center on Orchard Road. Not a chain, not a brand, an individual outlet. There is another for a Hokkien restaurant, another for a named chef's kitchen in Singapore, and there is a page on the site sitting quietly in the structure called Dine Out. I want to explain why I think that is one of the 2 most valuable things this company owns, and why the reason involves an American business that has been running the same model, profitably, since before most people in this industry were born. Come back to Rewards Network for a moment. It is owned by a private equity firm. It has more than 20,000 restaurants and 25 million enrolled card members. And it runs, essentially, every airline and hotel dining program in the United States, Mileage Plus Dining, A-Advantage Dining, SkyMiles Dining, Hilton Honors Dining. If you have ever earned miles for eating dinner, you have used it without knowing. The mechanics are almost embarrassingly simple. A restaurant agrees to pay a commission on what enrolled members spend there. The member links a card. When the card is used at that restaurant, the transaction is matched, the restaurant is billed, Rewards Network buys the miles from the airline program and credits them to the diner, and it keeps what is left. Now, Chapter 6 was a long argument that card-linked offers are a bad business. So why does this one work? Because it is vertical and Cardlytics was horizontal. That distinction turns out to be everything. Cardlytics sold reach across all of commerce to any marketer with a budget. which meant it competed with Google, Meta, Amazon, and every retail media network on Earth in an auction where the buyer has infinite alternatives. That is why its contribution per user was 50 cents a year and falling. Rewards Network sells one category to one kind of merchant, and it sells something that merchant cannot buy anywhere else. Restaurants have brutal fixed costs, thin margins, and empty tables on a Tuesday that are worth precisely nothing once Tuesday is over. An incremental diner is worth a lot to them, and a diner who chose the restaurant because of miles is demonstrably incremental. So the merchant pays a real commission, not an advertising rate, a share of the sale. And the reward is funded out of that commission rather than out of the platform's own margin. Look at what that does to the coupling problem. In HeyMax's core business, HeyMax earns a commission and then spends part of it on miles, so revenue and cost move together and the spread is fixed. In the dining model, the commission is larger. Restaurant marketing commissions in this model run well above general merchandise affiliate rates. Though I should say plainly that Rewards Network is private and does not publish its take, so I am not going to put a number on it that I cannot source. What I can say is structural. The wider the merchant commission, the wider the spread between what comes in and what the miles cost, and dining is one of the few categories where the merchant's willingness to pay is genuinely high. It is also, and this matters for a small team, high frequency. People shop online occasionally. People eat constantly. A dining product turns a rewards app from something you open when you are about to buy a laptop into something you open on a Thursday evening. That is the difference between an app with 150,000 users and an app with 150,000 habits. And HeyMax has already done the hardest part. Building a merchant graph down to individual outlet level across a city is grinding, unglamorous work. 4,700 pages of it exist. The dining surface exists. The card linking capability exists too. Card Maximizer already runs on the Visa Offers platform, which is precisely the infrastructure that matches a card transaction to a merchant. The pieces are on the table. What is missing is the commercial model, going to restaurants and selling them incremental covers, rather than listing them as merchants and hoping. Now I have to be honest about the costs because they are real. Signing restaurants is a feet-on-the-street business. 20,000 restaurants took Rewards Network decades and a sales organization. HeyMax has neither. In Singapore, the addressable universe is a few thousand outlets rather than 20,000, which is both a limitation and a mercy. It is a market a small team could plausibly cover, especially with a self-serve sign-up and an aggregator or two. And there is a real competitive question, because ShopBack has been doing offline card-linked cashback in Singapore since 2018 and Fave has been doing it too. Neither, though, can pay in a transferable airline currency, and that is the whole differentiator. Cashback gives a diner 4%, miles give them a story about Tokyo. So dining is my second recommendation, and I rank it second rather than first because it needs a commercial motion that selling the currency does not. But it is the one product where HeyMax's existing, unglamorous, 4,000-page asset suddenly becomes the moat. Now let me turn to the other place the money can come from somebody other than the shopper, and it is the fourth product on that business page, the one with no case study attached. Employee benefits. The pitch, as written, is transforming employee perks with Max Miles, with tailor-made solutions to enhance loyalty within your organization. There is no named customer. There is no evidence anyone has bought it. And structurally, it is the most decoupled idea on the entire page. Think about what happens. A company buys Max Miles with cash, real money, out of a human resources budget and distributes them to staff as a recognition or retention benefit. HeyMax issues miles and receives cash for every single one. There is no shopping commission involved, no merchant, no affiliate link, no attribution window. Just currency sold wholesale. And the customer acquisition cost is close to zero, because one purchasing decision by one human resources director puts the currency into the hands of 200 employees at once. Every one of those employees now has a max miles balance and a reason to download the app. It is business-to-business revenue that produces consumer growth as a byproduct, which is the opposite of the usual trade-off. There is a reason corporate gifting is a large, boring, profitable industry, and a reason airlines and hotels all sell into it. So why is it fourth on the page with no customer? Because it needs a salesperson. Human resources departments do not buy from a self-serve form. They buy from a person, after a meeting, with an invoice and a purchase order and a procurement process. And as we established, HeyMax has no salespeople, is not hiring salespeople, and is deliberately building a company designed not to need them. Which means I have to be straight about what employee benefits actually is in the current organization. It is not a product recommendation. It is a hiring plan. And that is a legitimate thing to recommend. One commercial hire with a corporate remit is not a big bet, but it must be called by its right name. Every strategy document in the world is full of ideas that are really hiring plans in disguise, and the test I applied in Chapter 8 is the one that separates them. Can the company that exists today ship this? For selling the currency self-serve, the answer is yes. For dining, the answer is yes with effort. For employee benefits, the answer is not until you hire someone. So, build the first, build the second, and hire for the third when the first two are paying for it. There is a third source of money on that page, though, and this one requires no new sales motion at all, because HeyMax is already collecting it, and almost nobody has noticed. It involves selling other people's points rather than its own. Chapter 11, Being the Buy Side. On the 1st of June 2026, HeyMax killed a product called Cash for Miles, and in doing so removed 17 loyalty programs from what its users could reach, 14 airlines and 3 hotel groups: Aeroplan, American A Advantage, British Airways, Emirates, Etihad, Qantas, Turkish, United, Hilton, Marriott, Hyatt. The community reaction was what you would expect. It looked like a company shrinking. I want to argue that it was the single most sensible piece of product surgery HeyMax has performed, and that the reason is visible in what it did not remove. First, what Cash for Miles actually was, because this is widely misunderstood and one of the earlier volumes in this series got it wrong. It was not a set of transfer partnerships. It was a manual workaround. You submitted a form. Within up to 5 business days, you received a virtual Visa debit card. You then used that card to buy points directly on the airline's own website. That is not a rail. That is a member of staff doing an errand on your behalf with a 5-day turnaround and a debit card. It was, as one Singapore Miles publication put it, always unsustainable. So HeyMax cut the cost side. Fine, but now look at the sitemap. Every one of those programs is still there. Marriott Bond Points Purchase, World of Hyatt Points Purchase, United Mileage Plus Miles Purchase, Etihad Guest, Air France KLM, Lufthansa Miles and more, Southwest, Melia, 13 pages in all, sitting quietly in the merchant estate. They are not destinations anymore. They are merchants. Which means when a HeyMax user clicks through and buys points directly from Hilton or United, HeyMax earns a commission from that airline or hotel and issues max miles on the purchase, funded out of that commission. They kept the revenue side and dropped the cost side. That is not shrinking. That is the correct trade, executed cleanly. And it points at the third product on that business page, the one written for airlines and hotels rather than for brands or shoppers. The heading is Redemption Partner, and the copy reads, Join the world's top airlines and hotels that drive miles sales revenue by partnering with HeyMax. Read that carefully, because it is the reverse of everything else in this book. Everywhere else, HeyMax is the buyer of loyalty currency. It needs Cathay miles and Accor points to make max miles worth holding. Here, it is the seller's channel. It is offering an airline distribution, access to a specific, valuable audience of people who are actively trying to accumulate miles and who are, by construction, willing to pay cash for them. Why would an airline care? Because selling points directly to members is one of the most profitable things a loyalty program does, and it is chronically underdistributed. Go back to Chapter 2. American Airlines disclosed that in 2019 it collected $538 million from selling miles directly to its own members. That is retail. And retail prices are brutal. KrisFlyer will sell you miles at about 4 US cents each and, unusually, never discounts them. Airlines list points at 3 to 4 cents and run promotions down to 1.5 or 2.5. Hotels list at a cent and promote at half that. Compare those retail prices with the wholesale rates from the last chapter, roughly 1.4 to 2 US cents in North America, and my estimate of half that in Asia Pacific. Retail runs at 3 to 5 times wholesale. It is the fattest margin in the entire loyalty business, and it is sold almost entirely through the program's own websites to people who happen to wander in at the right moment. Anybody who can reliably deliver buyers to that page is delivering something genuinely valuable. And HeyMax has exactly the audience. 150,000 people whose entire relationship with the company is about accumulating miles, sitting inside an app that already knows how many miles they have and how many they need for the trip they are looking at. The moment a user is 4,000 miles short of a business class seat is the single highest intent moment in this entire industry, and HeyMax owns that moment. Now, I have to handle the competitive question honestly, because Chapter 7 should have made you skeptical. Plusgrade, which owns points, already does loyalty currency retailing for airlines. That is literally its core business: buy, gift, reinstate, transfer on behalf of the program. In February 2026, it launched exactly that capability for China Airlines. It has Singapore Airlines, Cathay, Japan Airlines, All Nippon, and EVA on its partner wall. So is HeyMax competing with Plusgrade? No, and the distinction is the whole point. Plusgrade owns the rail. It runs the checkout, the fraud screening, the settlement, and it gives the airline an annual revenue guarantee for the privilege. That is a capital-intensive, contract-heavy business that HeyMax cannot enter for all the reasons Chapter 7 laid out. What Plusgrade does not own is demand. It is plumbing. It sits on the airline's own website waiting for someone to arrive. It has no audience of its own, no app, no relationship with the buyer, and no way to know that a particular person is 4,000 miles short this afternoon. HeyMax would not be competing on the rail. It would be feeding it, an affiliate to the buy points business rather than a rival to it. And affiliates do not need revenue guarantees, do not carry credit risk, and do not pay processing fees. They take a commission for delivering a customer. Which is why this line is close to pure margin. There is no mile issued against it, or if there is, it is a small promotional issuance funded many times over by the commission. There is no inventory. There is no float. There is no license. It is, in the vocabulary of Chapter 1, fully decoupled revenue. And it already exists, 13 pages of it live today. So the recommendation here is not build a new product. It is, notice what you have and take it seriously. Right now, those 13 pages are passive listings inside a 4,000-page merchant estate, which means they earn only when somebody stumbles across them. The version that matters is active. When a user opens FlyAnywhere and is short of the miles they need, that is the moment to say, "You are 4,200 miles short of this seat. Here are 3 ways to close the gap," one of which is buying points directly from the airline at today's promotional rate. That is a feature, not a business unit. It could be built by 2 people in a quarter. It requires no new partner, no new license, no new headcount, and it monetizes the single highest intent moment the product has. I want to add one caution, because it would be dishonest to leave it out. Selling somebody points at 3 cents when your own currency redeems at 1.8 is a moment that requires care. Done carelessly, it looks like the company profiting from its members' impatience, and the whole enterprise rests on those members trusting the currency. Done well, it is genuinely useful. Most people short of an award seat would rather buy the gap than wait 6 months. and they are going to do it anyway on some website with worse information. The rule I would apply is simple. Never present buying points as the default when earning them would do. Present it as one option with the arithmetic shown, including the cost per mile compared with FlyAnywhere. If the honest comparison makes the offer look bad, that is a signal not to make the offer. That is 3 products where somebody other than the shopper pays: the currency sold wholesale, the merchant who wants covers, and the airline that wants to sell its own points. None of them requires a license. None requires a balance sheet. 2 of the 3 require no new hires at all. But there is a 4th, much larger pool of margin sitting inside a product HeyMax already runs, and it has been hiding in plain sight since the day FlyAnywhere launched. Chapter 12: The Travel Business Hiding Inside FlyAnywhere. Booking Holdings, the parent of Booking.com, Priceline, Kayak, and Agoda, put $186 billion of travel through its systems in 2025. It kept $26.9 billion of that as revenue, 14.5 cents in every booking dollar. That is what the best travel distributor in the world earns for the act of standing between a traveler and a hotel. And I want to use that number as the frame for this chapter, because HeyMax is already, quietly, in the travel distribution business, and I do not think it has fully noticed. FlyAnywhere is the product. You spend max miles at roughly 1.8 Singapore cents each against any seat on any airline with no blackout dates. Since July 2025, it also handles award flight redemptions. Strip away the loyalty framing and describe what actually happens. A customer arrives with stored value, chooses a flight, and somebody sources that flight and delivers a ticket. That is a travel agency. It has a currency instead of a credit card at the front, but the back end is procurement and fulfillment. So the natural question is whether to lean into it. Hotels, packages, insurance, experiences, the full booking engine, and become properly what it is already partially. Let me give you the real economics, because they are more interesting than either the optimists or the pessimists usually allow. Start with that 14.5% and then watch what happens to it. Booking spent $8.2 billion on marketing in 2025, 4.4 cents of every booking dollar, or 30.4% of its revenue. After everything, net income was $5.4 billion, which is 2.9% of gross bookings. So the chain runs 14.5 cents of revenue, 4.4 cents straight back out to Google and the other channels to acquire the customer, and just under 3 cents of profit at the end. And note the composition, because it matters for anyone thinking about flights. Booking's own annual report says the take rate was dragged down in 2025 by a rising mix of flight bookings, which carry lower revenue as a percentage of gross bookings. Flights are the low-margin end of travel. Everyone knows this in the industry, and almost nobody says it outside it. Airlines pay agents close to nothing, which means FlyAnywhere, as a flight product, is almost certainly the thinnest possible version of travel distribution HeyMax could have chosen. It exists because it is the redemption promise, not because it is a good margin. Now the number that changes the argument: Expedia. Expedia put $119.6 billion of bookings through in 2025 at an overall take rate of 12.3%. But split it in two and something striking appears. Its consumer business, the thing you think of as Expedia, earns a take rate of 11.3%. Its business-to-business arm, which supplies inventory into other people's websites and apps, earns 13.6%. The wholesale business outturns the retail business. And it is growing 4 times faster. Business-to-business bookings grew 20% in 2025, while consumer grew 3%. Why would supplying somebody else's front end pay better than running your own? Because the partner absorbs the customer acquisition cost. Expedia spent $7.3 billion on direct selling and marketing last year, essentially 50% of its revenue, buying customers. When it supplies a partner instead, the partner does that work and Expedia keeps a cleaner margin. Now read one more line from Expedia's own filing. It defines direct selling and marketing as explicitly including private label and affiliate program commissions. And it says that line rose $503 million in 2025, driven primarily by an increase in business-to-business partner commissions. That is the line HeyMax gets paid out of. Somewhere inside that $500 million increase is the pool that companies like HeyMax draw from. So put the two facts together, because this is the whole argument of the chapter. The high-margin position in travel is being the front end with the customers and letting somebody else carry the inventory, the operations, and the risk. HeyMax already has the front end. It already has the customers. It already has the highest intent moment in consumer travel, a person with a balance of miles looking at a destination, deciding whether they can afford to go. What it does not have and should not want is the back end. Because here is where I part company with the obvious recommendation. Building a real travel business means contracts with bed banks and consolidators, an accreditation to issue tickets, bonding and financial guarantees, a license from the tourism board, a servicing desk for when a flight is canceled at 2 a.m, and a refunds and disputes operation. Travel is an operations business. It runs on people. And Chapter 8 told us what kind of company HeyMax is deliberately becoming. 30-odd people, no new engineering hires, a customer experience function explicitly designed to scale without headcount, using artificial intelligence agents on an off-the-shelf support platform. A company optimizing to serve 100 markets without hiring should not take on the single most service-intensive consumer category there is. Travel disruption is not a support ticket you can deflect with a chatbot. It is somebody stranded in Fukuoka. So my recommendation on travel is deliberately narrower than the opportunity, and I want to be clear that I am choosing narrowness on purpose. Do not build an online travel agency. Become the front end that somebody else's travel agency pays for. Concretely, take the affiliate and private label arrangements that already exist in this market, the Expedia Partner Program, Agoda, Klook for Experiences, the insurance and eSIM providers, and build a proper travel surface inside the app that earns commission on bookings HeyMax's users are making anyway. Hotels where the take rate is genuinely good rather than flights where it is not. Experiences and attractions where commissions are richer still. And the ancillaries around a trip that somebody has already committed to. I should be honest that I could not source a reliable public commission rate for travel insurance, eSIMs, or attractions in this market. Those rates are negotiated and unpublished, and I am not going to put a number on them that I cannot stand behind. The structural point survives without it. Ancillaries carry higher margins than flights, and HeyMax already has an eSIM relationship with Airlo that its own head of partnerships describes as having branched beyond affiliate. There is one more asset here worth naming precisely, and then one caution about it. Rob Rosenstein, who co-founded Agoda and chaired it, is an angel investor in HeyMax. He put money in at the Series A alongside David Lee, a former president of Visa Asia Pacific. That is an unusually well-chosen pair of angels for a company sitting exactly between travel and payments, and it is reasonable to infer that travel distribution advice is available to this company at a level most startups cannot buy. But an investor is a signal, not a deal. There is no Agoda partnership. There is no announced arrangement of any kind. I want to be careful not to build an argument on a cap table entry. So where does travel rank? Third and later. The margin is real, the front end already exists, and the wholesale versus retail lesson from Expedia is genuinely important. But it is a supply and operations business at its core, and the two products ahead of it, selling the currency and the merchant-funded categories, are software and commercial deals rather than operations. You do the ones that fit the company you have before the one that needs a company you would have to build. And there is a reason to wait beyond capacity, which is that HeyMax may be about to acquire something in travel that nobody else in Asia has. Not inventory, not contracts. Information. Chapter 13. The Data Nobody in Asia Owns. On the 15th of July, 2026, HeyMax shipped something that does not live in its app. It is called Award Companion, and it is a browser extension. You install it, you log into Singapore Airlines website as normal, and it quietly scans a wide range of dates and paints you a heat map, a calendar showing where KrisFlyer Saver Award seats actually exist. Then it drops you back into the matching results. It is free. It is not gated behind HeyMax first. And in the announcement, HeyMax called it Chapter 1 and named where it goes next: Cathay, Qatar Airways, Air France KLM, and EVA Air. I want to argue that this is the most strategically interesting thing HeyMax has built, and that almost nothing about why is visible in the product itself. First, a correction to the framing, because I nearly got this wrong. Award Companion is often described as HeyMax's first product outside its own app. It is not quite. There was already a Chrome extension called HeyMax, Double Your Miles, linked from the company's own affiliate page. So this is the widening of an existing beachhead rather than a first landing, which, if anything, makes it more deliberate. Now, the surface reading. Award availability is the great unsolved misery of this hobby. You accumulate miles for 2 years, you sit down to book the trip, and there are no seats. Not no seats on the plane, no seats released at the award price, on your dates, in your cabin. So you begin the grind. Check a date, check the next date, change the month, change the origin, try again next Tuesday. A tool that shows you the whole month at a glance is genuinely, immediately useful, and it makes the currency feel more valuable without HeyMax having to give anybody anything. That alone would justify building it. But that is not why it matters. It matters because of what is flowing in the other direction. Every time somebody runs that extension, HeyMax learns something about which seats existed, on which route, in which cabin, on which date, at which moment. Multiply that by a user base of people whose defining characteristic is that they search for award seats obsessively, and you are not running a search tool. You are running a distributed sensing network for award inventory across Asia. And here is the fact that makes it valuable. Nobody owns that dataset for this region. There is a small industry of award search tools in the United States: Expert Flyer, Seats.arrow, Point.me, Award Tool, and others. They are good, they are well established, and they are overwhelmingly built around American and European programs. Asia-Pacific award inventory, and KrisFlyer in particular, is comparatively unmapped. So what is that data actually worth, and to whom? To HeyMax itself, first and most obviously. Knowing where award seats really are makes FlyAnywhere smarter. You can steer a member toward a redemption that will actually succeed, which raises satisfaction and lowers the support burden of failed bookings. It makes the transfer decision better, whether to send miles to Cathay or EVA for a given route stops being a guess. And it makes the whole product feel like it knows something, which is precisely the positioning Joe Liu keeps reaching for when he calls HeyMax the Duolingo of personal finance. The idea that it will cost nothing to be smart and savvy because the software will do it for you. To others, second, and here I want to be careful, because the obvious commercial move is also the dangerous one. Award inventory data is genuinely valuable to travel businesses, to consultancies, to anyone building award booking services. There is a version of this where HeyMax sells or licenses aggregate availability data and books high margin, fully decoupled revenue against it. I would not do that, at least not yet, and the reason is not squeamishness. It is that the data's supply depends entirely on the goodwill of the airlines whose websites are being observed, and on members' willingness to install something that watches them. Which brings us to the risks, and they are real enough that I want to state them plainly rather than bury them. The extension is explicitly experimental, unofficial, and not endorsed by Singapore Airlines. That is HeyMax's own characterization, and it is the honest one. Automated scanning of an airline's award calendar sits in uncomfortable territory with most airlines' terms of use, and airlines have historically been hostile to exactly this. The American award search industry has a long history of tools being rate-limited, blocked, sued, or quietly strangled. So the supply of this data can be terminated by a single engineering decision at an airline. Not a negotiation, not a notice period, a rate limiter and a bot detection rule shipped on a Tuesday. That makes it an option rather than a foundation, and options should be bought cheaply, held lightly, and never built into the load-bearing structure of a plan. There is a second risk, subtler and more corrosive, which is the relationship with the airline's HeyMax also needs as partners. This company's entire currency depends on 24 programs agreeing to accept transfers. Cathay is a partner. EVA is a partner. Those are 2 of the 4 programs named as next for Award Companion. There is a real tension in going to a loyalty program and saying, in one meeting, we would like to send you members and buy your miles at a good rate. And separately, we have built a tool that maps exactly which of your seats are cheap and shows our members where to find them. Loyalty programs make money on the gap between what members think miles are worth and what they extract. A tool that closes that gap is not obviously a gift to the partner. I do not think that makes it wrong. I think it makes it a thing to be handled deliberately rather than stumbled into, and it is the sort of judgment that a company with one person doing both regional management and global loyalty partnerships is uniquely placed to get right or wrong depending on the day. So here is my recommendation, and it is narrower than the enthusiasm might suggest. Keep building Award Companion. Extend it to the 4 named programs as promised. The engineering is already scoped, the intent already public. Treat the data as an internal advantage that makes redemption smarter, not as a product to sell. Do not build a business line on it while its supply is revocable. And keep it free, because its value to HeyMax is the sensing, not the subscription. But do not mistake it for the answer either. It is a differentiator and an option, not a revenue line. In a portfolio, it earns a modest place, cheap, clever, defensible while it lasts, and entirely at somebody else's mercy. And now we come to the chapter where the clock is loudest, the one place in this entire analysis where I think there is a genuine, closing window, and where somebody very large has already written HeyMax's product into their own roadmap. Chapter 14, the layer that does not exist yet. On the 19th of May, 2026, Google announced a product called Universal Cart. It is a shopping cart that follows you across search, the Gemini app, YouTube, and Gmail. It remembers what you were looking at. It watches for price drops in the background, tracks price history, tells you when something is back in stock. And in Google's own description of what it does, there is a phrase I have not been able to stop thinking about since I found it. It leverages payment perks. Read that again, slowly. A cart that reasons about which of your cards gives you the best return on a given purchase. That is HeyMax's product, described in a Google product announcement by somebody else as a feature of a shopping cart. I want to build up to why that matters properly, because the landscape underneath it is genuinely new and moving fast, and getting it right requires separating what has shipped from what has merely been announced. As of August 2026, there are 3 competing protocol stacks for what people are calling agentic commerce, the machinery by which an artificial intelligence agent can actually buy something on your behalf rather than just recommend it. The first is OpenAI and Stripe's Agentic Commerce Protocol, launched on the 29th of September 2025. It is open source, and its clever piece is something called a shared payment token, a payment credential scoped to one specific merchant and one specific basket total. The agent never sees your card. The merchant stays the merchant of record, charges the card, handles tax, fulfillment, and returns. The second is Google's, and it is 2 things. There is the Universal Commerce Protocol, published on the 11th of January 2026 with Shopify, Etsy, Wayfair, Target, and Walmart. And there is a P2, the Agent Payments Protocol, announced in September 2025 with more than 60 partners, which handles authorization through 3 cryptographically signed mandates, one for what you asked for, one for the exact cart you approved, one for the payment method. In April 2026, it formalized the case where the human is not present at all. You sign an instruction up front with price limits and conditions, and the agent buys when the conditions are met. The third stack belongs to the card networks: Visa's Intelligent Commerce and Trusted Agent Protocol, MasterCard's Agent Pay and Agentic Tokens, and it is largely about proving that an agent is who it claims to be. Now, look across all three of those stacks and tell me where the loyalty layer is. There isn't one. Discovery is solved. Checkout is solved. Payment authorization is solved 3 different ways. Agent identity is being solved. Nobody has built the layer that answers a question every shopper in Asia asks before they buy anything. Which card should I put this on, and what do I get back? That is the gap. It is the single clearest white space I found in this entire research effort, and it is precisely the thing HeyMax has spent 3 years building: a rewards engine that knows 4,700 merchants, 10 card products, and what each combination is worth. So why isn't this simply the answer? Because of the universal cart sentence. Google intends to fill that gap itself, as a feature, for free, inside the surface where half the world already shops. Let me give you the economics, because they are stark and they are moving. OpenAI charges merchants 4% of the order value on completed sales through ChatGPT checkout. That has been the operative figure on Shopify since the 26th of January 2026. 4% is roughly 2 to 4 times what a typical affiliate commission pays on general merchandise. It is a serious tax. Google's AI Mode and Microsoft's Copilot, meanwhile, charge nothing. For now, and I want to flag that for now is doing real work in that sentence. More importantly, on Shopify, merchant products are exposed to the free channels by default, and merchants have to opt in to the paid one. I should be honest about the limits of what I can verify here. There is no published OpenAI fee schedule anywhere. The 4% figure comes from reporting citing a Shopify spokesperson, and a lower figure of about 2% has circulated attributed to Sam Altman. I am treating 4% as operative and telling you it is not from a primary document. Now the second development, which changes the shape of the opportunity. On the 6th of March 2026, OpenAI deprioritized standalone instant checkout in favor of checkout happening inside merchant-specific ChatGPT apps, Target, Instacart, DoorDash. A spokesperson said instant checkout is moving to apps, where purchases can happen more seamlessly. That matters enormously for a company like HeyMax, because it means the unit of distribution inside these assistants is becoming the app, not the product listing. And an app is something a 30-person company can build. So the recommendation is specific. HeyMax should ship an agent surface, a proper interface that any assistant can call, and an app inside the assistants that people actually use, answering the questions it is uniquely equipped to answer. Which card for this merchant? What will I earn? How close does this get me to the seat I want? Where can I redeem what I already have? Why is this the right shape for this company in particular? Because it costs almost nothing to build if the reward engine already exists, and HeyMax's does. Because the job advertisements explicitly ask for a designer who has worked on agent and copilot patterns, and describe a customer experience function built on artificial intelligence agents. This is an organization already oriented this way. And because it requires no license, no capital, no partner, and no country manager. But I want to be equally clear about the case against, because it is not weak. The window is closing. Google has already written perk awareness into its cart. If Universal Cart reaches Southeast Asia with working card benefit logic before HeyMax ships anything, then this candidate is dead on arrival and should not be started. I could not find any Singapore or Southeast Asia launch date for Universal Cart. The rollout described is the United States first, then Canada, Australia, and the United Kingdom, and that absence is currently HeyMax's entire margin of safety. Now let me turn to the other half of this chapter, because the same shift threatens something HeyMax already owns. 5,206 pages. That is what is in HeyMax's sitemap. 4,729 merchant pages, about 430 pages of the form Best Credit Card for a Named Merchant, 18 or 19 city travel guides. It is a large, carefully built, programmatic search engine estate, and it is the top of the acquisition funnel. Every single one of those pages is built on an assumption that a person types a question into a search engine, sees a list of links, and clicks one. That assumption is now the thing being dismantled. When an assistant answers, "Which card should I use at Agoda?" directly, in prose, with no link, the page that would have answered it earns nothing. The traffic does not decline gracefully. The click simply does not happen. I want to be careful not to overstate this, because I could not obtain reliable, dated measurements of traffic decline for this specific category. The good data sits behind analytics subscriptions, and the public studies vary wildly. What I can say is directional and, I think, uncontroversial. Programmatic content built to capture informational search queries is the most exposed asset class on the internet right now, and Best Credit Card for Merchant pages are exactly that. So the honest way to hold these two halves together is this. The 5,000 pages are a melting asset, and the agent layer is a forming one, and they are the same shift viewed from opposite sides. The question is not whether to defend the pages. You cannot defend them. The question is whether the knowledge those pages encode, which card, which merchant, what it is worth, can be moved into the surface where the question is now being asked. That is why I rank the agent surface third rather than 10th, despite it having no revenue model I can point to today. It is the only candidate in this book that is simultaneously an opportunity and a hedge. And it should be built now, cheaply, before it is obvious, because the moment it is obvious, the company that wrote leverages payment perks into a product page will already have shipped it. Which leaves one product still to examine, and it is the one HeyMax has built most recently, most boldly, and, I will argue, most dangerously. Chapter 15, The Balance Sheet Product. On the 15th of July, 2026, HeyMax started lending people miles. The product is called HeyMax First, and the marketing line is Fly Now, Earn Later. At the top tier, you can draw up to 1 million max miles before you have earned a single one of them. You pay what the company calls an access fee to unlock them, in blocks of 10,000, and then, this is the sentence from the announcement, members earn the miles back through everyday spending on HeyMax. There is no deadline, no penalty, and no minimum activity. I have read a lot of loyalty product launches. I have never read one quite like this, and I want to take it seriously, because I think it is simultaneously the cleverest thing this company has built and the one most likely to end it. Start with the pricing, because at first glance it makes no sense at all. The access fee runs from 3 cents a mile at the free silver tier down to 2.3 cents at the reserve tier. And HeyMax's own redemption engine, FlyAnywhere, values a max mile at about 1.8 cents. So you are paying up to 3 cents for something the company itself will only give you 1.8 cents of value for. On the face of it, that is a terrible deal, and if it were a price, it would be indefensible. But it is not a price. It is fully reclaimable. You get the entire fee back in 10,000-mile increments as you earn miles normally through shopping. Which means it is a deposit, and that changes what this product is completely. Let me restate it in plain financial language. A customer gives HeyMax cash. HeyMax immediately gives the customer a redeemable asset, miles they can transfer to an airline tomorrow. The customer gets their cash back later if and only if they keep transacting through HeyMax. There is no deadline, no penalty, no minimum activity, and since the 5th of June 2026, eligibility to reclaim persists indefinitely even if the paid membership lapses. That is unsecured consumer credit, denominated in miles, funded off HeyMax's own balance sheet, with no collateral, no underwriting that I could find disclosed, and exactly one recovery mechanism: the customer choosing to keep shopping. And here is the part that matters for this book's central argument. Because the fee is fully reclaimable, it is almost certainly not revenue. Money you are contractually obliged to give back is a liability, not a sale. So what does HeyMax actually get? Float, cash in the business, held for an indefinite period. At the reserve tier, 2.3 cents against 1 million miles is roughly 23,000 Singapore dollars parked by a single member. And a powerful behavioral lock. A member with money on deposit that can only be recovered by shopping through HeyMax has the strongest possible reason to route every discretionary purchase through HeyMax. Now look at what happened 6 weeks after launch, because the sequence tells you something. On the 5th of June 2026, and note that is actually before the full launch, during the rollout, 3 changes landed together. The silver tier was made free forever. Downgrades were permitted even where the outstanding drawdown exceeded the lower tier's pool, and reclaim eligibility was extended indefinitely. Every one of those changes loosens the product in the customer's favor. Every one removes friction. When a company relaxes terms that quickly, the usual explanation is that conversion came in below plan and they moved fast to fix it. That is my reading, and I want to label it clearly as my reading rather than a fact. But notice which part they made free. The membership fee, $299, $699 and $1,999 Singapore dollars at the paid tiers, is genuine, fully decoupled revenue. Cash in, no mile out, recognized immediately. The access fee is float, cash in, mile out, cash back later. They made the revenue part free at the entry tier and kept the funding part. I do not think that was cynical. I think a free silver tier turns HeyMax first from a premium product into the default onboarding path for every new user, which is strategically much bigger than a membership business. But it does mean that as this product scales, HeyMax accumulates float and behavioral lock-in rather than earnings. So what are the risks? There are 3 and they compound. The first is the one an independent loyalty consultancy named in its review, and it is the sharpest question anyone has asked about this product. Will members work as hard to repay a balance they have already enjoyed as they would to reach a reward still ahead of them? Nobody knows. That is the entire underwriting question, and it is unanswerable from outside, and, I suspect, from inside, because the product is 3 weeks old. The behavioral literature on buy now, pay later is not encouraging about post-consumption motivation. If a meaningful share of members draw 1 million miles, fly to Tokyo in business class, and then quietly stop shopping, HeyMax has bought them a holiday and holds a receivable it cannot collect. The second risk is the regulatory perimeter, and here the facts are genuinely interesting. The regulator in Singapore has been clear that it does not intend to treat ordinary retail loyalty programs as payment services. Loyalty points can sit outside the perimeter as limited-purpose electronic money. Fine. But it also weighs whether a scheme is marketed as loyalty or as something closer to payments. And this product takes real cash from consumers, holds it indefinitely, and returns it conditionally. Now put beside that a detail from Chapter 4 that I think is the most quietly deliberate thing in this whole research. On the 1st of April 2026, HeyMax opened its global headquarters. The guest of honor was Alvin Tan, a minister of state and a board member of the Monetary Authority of Singapore. 3 months before launching a product that takes customer deposits, HeyMax invited a member of the regulator's board to cut the ribbon. I am not going to allege anything about that, and there is nothing to allege. Ministers open offices, that is part of the job. But a company that was not thinking about its regulatory relationship would not have bothered. And there is a hard constraint here that Chapter 5 uncovered. Under the Payment Services Licensing Guidelines, a licensed institution's customer money must be segregated with a named safeguarding institution. That float is not working capital, and it is not yours to earn a return on. If HeyMax first ever grows to the point where the regulator decides it is inside the perimeter, the float stops being an asset and becomes an obligation overnight. The third risk is the one this whole book keeps circling, the promise. Miles never expire, transfers are one-to-one, there are no blackout dates. That promise is why the currency is worth holding, and it is the foundation under every recommendation in this book: the long-tail currency sale, the merchant products, the agent layer, all of it. A credit product that goes wrong does not fail quietly. It fails by the company needing money, and the fastest way for a loyalty company to raise money from its own balance sheet is to devalue. And now recall the sequence of 2026, which I do not think is 3 unrelated events. Cash for Miles killed on the 1st of June. A core cut from 1-to-1 to 3-to-2 on the 1st of July. Miles lent out in million-mile blocks on the 15th of July. Tightening the currency's value while extending its timing. That is the classic loyalty playbook, and it is exactly what you would do if you were preparing a currency to be lent. So, the verdict: I would keep HeyMax first. It is genuinely differentiated, it is a real reason to choose this app over a cashback app, and the free silver tier is a strong onboarding mechanism. But I would do 3 things immediately, and I would rank them above every new product in this book, because this is a repair rather than a build. Price the risk. Somebody needs to model what share of drawn miles will never be earned back and hold capital against it. Right now, that number does not exist publicly, and given there is no risk function, I doubt it exists at all. Staff it. There is no risk role, no credit role, no underwriting, collections, or compliance role posted anywhere at this company. A business that lends should have somebody whose job is to worry about lending. That is not a nice to have. It is the difference between a clever product and an unmanaged exposure. And disclose the shape of it. Not the numbers, no early-stage company should publish its receivables, but whether access fees are segregated and what happens to a member's deposit if HeyMax fails. Reviewers have already named the counterparty risk out loud. The access fee is capital a member has parked with a venture-funded startup. Answering that question is cheap, and it protects the promise. That is the last of the candidates. 11 ideas, 3 chapters of refusals, and a set of 6 axes I promised at the beginning I would score them against. Time to do the scoring, and to say plainly which ones I would build. Chapter 16, Scoring the Slate. I promised at the beginning that I would show my working, so here it is. 12 candidates, 6 axes, each scored out of 5 for a maximum of 30. And I want to walk you through the axes first, because the ranking is entirely a consequence of them, and if you disagree with an axis, you should disagree with the answer. The first axis is decoupling. Does the revenue arrive without a max mile going out against it? This is the whole thesis of the book, so it carries the most weight in my thinking even though I have not weighted it arithmetically. The second is defensibility. In 2 years, could a competitor copy this in a quarter? The third is capital cost. Can it be built inside $13.6 million, most of which is already committed to running the company? The fourth is organizational fit, and this is the axis that does the most work, so hold on to it. Can the company that exists today, of roughly 30 to 38 people, with no salespeople, no credit function, no country managers, and no open engineering roles, actually ship this? The fifth is trust risk. If it fails, what does the failure do to the promise, never expires, 1-to-1, no blackout dates, on which everything else rests? And the sixth is portability. Does it work in the third market without finding a new anchor partner there? Now the results from the bottom. Last, at 11 out of 30, is HeyMax issuing its own card. It scores badly almost everywhere. It is coupled because every dollar of interchange obliges a mile. It is not especially defensible. It is enormously capital hungry. Remember the regulator's expectation of 6 to 12 months of operating expenses as base capital, which for this company is several million US sitting idle. It has no organizational fit whatsoever, because there is nobody here who does credit or compliance. And its trust risk is the highest on the board, because a payments product that stumbles is the fastest route to a chocolate finance week. Second from bottom, at 13, is horizontal card-linked offers. Cardlytics has run that experiment for 8 years and ended at roughly $20 million of market value, with contribution per user of about 50 US cents a year, falling. 3rd from bottom at 15, is selling loyalty infrastructure to banks. It scores well on decoupling because software revenue is clean. It scores near 0 on organizational fit and on defensibility because Ascenda has 255 people in DBS, Plusgrade has Singapore Airlines and Cathay, and the platform fee has already been abolished. Now, 4th from bottom at 14 is HeyMax first, and I need to explain that score carefully, because it is the one place where the framework misleads if you read it lazily. 14 out of 30 does not mean shut it down. HeyMax first already exists, it is live, and it is genuinely differentiated. What the score is telling you is that it carries the worst risk profile on the board, an unpriced credit exposure, an unstaffed one, sitting closest to the regulatory perimeter, attached to the promise that everything else depends on. Read that 14 not as a verdict on whether to start it, but as a work order for fixing it. Then the middle of the table, where things get more interesting than the scores alone suggest. Product-led expansion scores 16. It is genuinely portable, that is its whole design, and cheap, and it fits the organization perfectly, because the entire point of that country launch machine is to open markets without hiring. What drags it down is decoupling, where it scores at the very bottom, because more markets is definitionally more of the same coupled revenue. It belongs in the plan. It is not the answer to the question this book is asking. Employee benefits and the corporate channel scores 17, and the reason is a single axis. On decoupling, it is close to perfect. A company writes a check and HeyMax issues miles, with no shopping commission anywhere in the transaction, and the customer acquisition is free because one purchase order puts the currency in 200 pockets. But organizational fit is where it dies, because human resources departments do not buy from a form. As I said in Chapter 10, this is not a product recommendation, it is a hiring plan. Ranked as a hiring plan, it is a good one. Award Companion and the data behind it scores 18, cheap, clever, differentiating, and capped because its supply can be switched off by one airline engineer on one Tuesday afternoon. An option, not a foundation. Travel as a front end scores 19. Real margin, a genuine lesson from Expedia that supplying somebody else's front end outturns running your own, and a front end HeyMax already owns. Held back by organizational fit, because travel is an operations business, and this is a company deliberately building itself not to have operations. Now the top 4. 4th at 22 is being the buy side, points retailing, the redemption partner line. It scores at the very top on decoupling because there is no mile issued against it and no inventory, no float, and no license. It scores at the top on organizational fit because it is a feature 2 people could build in a quarter using 13 pages that already exist. What holds it to 22 is simply size. It is the highest return per unit of effort on this entire board, and it is not large enough on its own to change the company's shape. Build it because it is nearly free, not because it is transformative. 3rd, at 23, the agent surface. Its scores are strange and worth understanding. On decoupling, I cannot score it confidently at all because there is no proven revenue model. I have marked it in the middle rather than pretend. On defensibility, it is weak because Google can do this and has said it intends to. On organizational fit and capital cost, it is excellent because an artificial intelligence native team can build an interface cheaply. What lifts it to 3rd is that it is the only item on this board that is both an opportunity and a hedge. The one thing that answers what happens to 5,206 search engine pages when the click disappears. 2nd, at 24, dining. Merchant-funded, high frequency, and it converts 4,700 merchant pages from a search engine asset into a commercial one. It is the only version of card-linked offers with a working 20,000 restaurant proof behind it, and the proof exists precisely because it is vertical rather than horizontal. It loses points on organizational fit because signing restaurants is real commercial work, and that is why it is second rather than first. And first, at 27 out of 30, is selling the currency itself, self-serve to the long tail. It is the only candidate that scores 4 or 5 on every single axis. Decoupled, because the partner pays cash for a mile HeyMax controls the price of. Defensible, because the redemption network behind it took 3 years and $13 million to assemble, and a competitor cannot rent one. Cheap, because the currency already exists, and what is missing is a rate card, an interface, and documentation. Portable, because it needs no anchor in any country. A fintech in Manila can integrate on a Tuesday without HeyMax having a single employee in the Philippines. Low trust risk, because it does not touch the promise. And critically, it fits the organization exactly. It is a self-serve software product for a company that has explicitly decided to grow without hiring salespeople. Now step back and look at the column that separated the winners from the losers, because it is not the one you would expect. It was not decoupling. Employee benefit scores, as well as anything on decoupling, and lands 7th. It was organizational fit. Every idea that ranked in the top 4 can be shipped by 30 people with no sales team, no credit team, and no country managers. Every idea that ranked in the bottom 4 requires a company HeyMax would first have to become a licensed issuer, an enterprise sales organization, an advertising business. That is not a coincidence, and it is not a limitation of my framework. It is the actual constraint. Strategy documents are full of correct ideas that die because the organization could not carry them, and the reason they die is that nobody scored the organization. Which gives us a short list. Sell the currency, own dinner, occupy the agent surface, and switch on the points retailing feature because it is nearly free. Now the harder question. In what order, with what money, and by when? Chapter 17. What I would build and in what order. HeyMax has raised $13.6 million in its life. $2.6 million in July 2024, $11 million in January 2026. I estimate the company is burning somewhere between $400,000 and $600,000 a month, and I want to show you that working because it drives everything else in this chapter. Roughly 30 to 38 people in Singapore, a stated intention to double local headcount by 2027, 2 live markets, and a global headquarters with a lease on it. At Singapore salaries, that is my range. It could be lower if they are leaner than I think. At that burn, $11 million is 18 to 27 months of runway from January 2026, which puts the next fundraising conversation somewhere between the middle of 2027 and the beginning of 2028. So the brief is not abstract. It is, what can be true about this business in roughly 18 months? Now here is the thing that makes HeyMax's position unusual, and I think genuinely misunderstood, possibly inside the company as well as outside it. The market's bar for a Series B in 2026 is something like $5 to $10 million of annualized revenue, with strong retention and a burn multiple between 1 and 1.7. Forward revenue multiples cluster between 8 and 15 times. HeyMax already claims $6 million. It is already past the threshold, which sounds like good news and is actually the trap, because when you are already at the number, nobody is impressed by the number. The question shifts to what kind of revenue it is. And that is where the 2 acquisition prints from earlier in this book stop being trivia and become the entire argument. Points.com, the global incumbent in loyalty commerce, growing revenue at 96% year-on-year at the time of sale, profitable, category-leading, sold for 1 times its revenue. Talon.one, a promotions and loyalty engine with about 60 million euros of annualized revenue growing 30 to 40%, sold to a DN for 12.5 times. Same industry, 4 years apart, 12 times the multiple. The difference was not the market. It was that one of them moved gross transaction flow at a 14% margin and carried the credit risk, and the other sold software at software margins and carried none. So $6 million of coupled shopping commission and $6 million containing $2 million of currency licensing, membership and merchant-funded revenue are not the same asset. They will not raise at the same price. They may not both raise at all. The brief stated properly. Between now and the middle of 2027, convert a single-line, coupled, Singapore-centric revenue base into a multi-line business where at least a third of revenue is decoupled, without breaking the promise that makes the currency worth holding. Here is how I would sequence it. The first quarter is about charging for what already exists, and none of it requires a new hire. Publish a rate card for Max Miles, an actual page with actual prices for a brand that wants to issue Max Miles to its customers. Price the miles, not the software, because Ascenda abolished platform fees in 2024 and you cannot undercut zero. Ship an interface and documentation to go with it, a sandbox, keys you can generate yourself. The test is simple, and I would hold the team to it literally. Can a competent engineer at a 40-person fintech be issuing Max Miles within an afternoon without ever speaking to a human being? Today the answer is no, because the only route in is a contact form. Rewrite the standard terms so that no partner can do to HeyMax what Atom did in May 2026, when it repriced Max Miles by 47% in a single step, and there was nothing HeyMax could do. A floor on the exchange rate, a notice period, and the right to be removed from the partner's marketing on breach. And switch on points retailing inside FlyAnywhere. When a member is short of the miles they need, offer them the option of buying the gap directly from the airline, with the arithmetic shown honestly, including the cost per mile compared with FlyAnywhere. 13 merchant pages for that already exist and earn passively today. This turns them active. 2 people, 1 quarter. While that ships, do the repair from Chapter 15, because it should not wait behind anything. Model what share of drawn HeyMax first miles will never be earned back. Hold capital against it. Answer, publicly, whether access fees are segregated and what happens to a member's deposit if the company fails. The second and third quarters are the dinner table. Take the 4,700 merchant pages, the ones that already reach down to individual restaurant outlets, and turn dining into a commercial product rather than a directory. Restaurants pay a commission on incremental covers. The miles are funded out of that commission. This is the rewards network model, which is the one version of card-linked offers that has worked for decades, and it works because it is vertical. This one does need commercial effort, and it is where I would spend the first new headcount. Somebody who can sign restaurant groups and aggregators, not an enterprise sales team. Singapore is a few thousand outlets, not 20,000. That is a market a small team can cover. Also in this window, ship the agent surface. An interface any assistant can call and an app inside the assistants people actually use, answering which card, what will I earn, how close am I to the seat I want. Build it small and build it now, because Google has already written leverages payment perks into a shopping cart, and the only reason the window is still open is that Universal Cart has no announced Southeast Asia date. That is not a moat. That is a head start. The fourth quarter and beyond is where the hiring plans go. Employee benefits, with one commercial hire carrying a corporate remit. Travel as a front end, taking commission on hotels and experiences rather than building an agency. Both are good. Neither should go before the things that need nobody. An expansion runs underneath all of it, because that machine is being built anyway, and it is cheap. Open markets as a product feature, exactly as the Design Lab job advertisement describes. Just do not confuse it with the answer to the margin question. Now, what I have deliberately not done here is propose anything requiring a license, a balance sheet, an enterprise sales organization, or a country manager. That is not timidity. It is the constraint from Chapter 16 applied honestly. The test that separated the top 4 from the bottom 4 was organizational fit, and a plan that ignores it is a wish list. There is one more thing I would do, and it is not a product at all. Publish the wholesale price of a Max Mile. Not the partner-by-partner contracts, nobody expects that, and partners would never allow it. But the shape of it. What a brand pays in a band. Because right now the single most important number in this business does not exist in public, which means every investor, every partner, and every analyst, including me, is guessing. United published 2 cents. American published its per-partner pricing structure. Delta publishes the American Express check every year. They did it because when the number is good, the number is the argument. And I think HeyMax's number is probably better than people assume. If it is buying partner miles at Asia-Pacific wholesale rates, my estimate, roughly half of North American rates, and redeeming at 1.8 Singapore cents, the redemption side of this business is running at a margin comparable to what United disclosed. That is a good story. Nobody is telling it. Which brings me to the harder half of strategy and the part almost nobody does well. Not what to build, what to refuse. Chapter 18, What I Would Refuse. The chief executive of ShopBack, explaining why he had just cut a quarter of his staff and written off a business he bought 2.5 years earlier, described what went wrong in one phrase. The mistake of pursuing too many directions as a company. I have quoted that sentence 3 times now. I am going to quote it once more, because it is the most useful thing anybody in this industry has said out loud recently, and because it was expensive. It cost 195 people their jobs and an acquisition written to zero. Refusal is the half of strategy nobody writes case studies about. Every board meeting rewards a new initiative. No board meeting rewards a slide that says we considered 4 things and did none of them. And yet, in a company of 30 people with 18 months of runway, the things you decline are more determinative than the things you attempt, because attention is the binding constraint and there is no way to buy more of it. So here are the 3 refusals, stated compactly, with what would have to change for me to reverse each one. The first refusal is the card. Not because interchange in Singapore is unattractive, it is probably rather good, in a market where neither Visa nor MasterCard publishes a schedule because no regulator compels them to. The refusal is because of everything around the interchange. A major payment institution license, triggered at 3 million Singapore dollars of monthly transactions, which any real program crosses within months. A regulatory expectation of 6 to 12 months of operating expenses held as base capital, several million US dollars, doing nothing, out of 11 raised. Customer float segregated with a safeguarding institution, so it is not yours to earn on. A processing stack that costs the largest independent processor in the world 16 basis points at hundreds of billions of volume and would cost HeyMax more. Fraud, chargebacks, disputes, and an organization with no credit or compliance function whatsoever. And then the thing that settles it. Even if all of that went well, the revenue is coupled. A HeyMax card earns interchange and issues max miles against it. It is the same problem with a license attached. I would reverse this if HeyMax found a bank willing to carry the license, the capital, and the credit risk while HeyMax carried only the brand and the currency, a genuine co-brand rather than an issuing program. That is a partnership, not a product, and it would be a good one. The second refusal is selling loyalty infrastructure to banks. Ascenda has 255 people, 70-plus loyalty brands, 40 markets, HSBC, Standard Chartered, American Express, Capital One, Barclays, OCBC, and since April 2026, DBS. It abolished platform fees entirely in October 2024. It sells through Visa and through Galileo rather than one bank at a time. And from the other direction, Plusgrade holds Singapore Airlines and Cathay, and launched points exchange at financial institutions in March 2026. 2 well-capitalized owners, fighting over a rail that converts $1 of transaction revenue into 14 cents of gross profit, where the entry price is an annual revenue guarantee to an airline that a company with $11 million cannot write. I would reverse this if a bank came to HeyMax rather than the other way round, and it might, because HeyMax has something Ascenda does not, which is consumers. but I would not fund a sales team to go looking. The third refusal is horizontal card-linked offers at scale. 8 years of public evidence, a $1.4 billion accumulated deficit, a gross take of 27% after the shopper and the bank have been paid. Contribution per user of about 50 US cents a year at the top of the cycle, 11 cents a quarter now. Users up 18%, while contribution per user fell 35%. Bank of America gone on 90 days' notice. Chase simultaneously buying the technology, launching a competing network, and restricting which marketers may be served in its own app. Dosh and Bridge bought for around $856 million, and one of them sold for 5 cents on the dollar. I would reverse this only in the vertical form, dining, which is recommendation number 2, and which works for exactly the reason the horizontal version does not. Now the fourth refusal, and this is the one I actually worry about, because it is the one that will not present itself as a refusal at all. It is the card again, in disguise. Here is how it will arrive. Nobody will propose becoming a licensed issuer because that sounds hard and expensive, and somebody will have read Chapter 5. What will be proposed is something reasonable sounding and adjacent. A small stored value wallet just for FlyAnywhere to make redemption smoother. A prepaid product with a partner just for travel spending abroad. A single co-brand pilot just to test demand. Something that lets HeyMax hold a little customer money just for a moment, just for convenience. And every one of those is a step across the same line because the line is not the plastic. The line is holding customer money. Notice that HeyMax has already taken one step across it. HeyMax first takes real cash from consumers and holds it indefinitely against miles delivered immediately. That is a company already holding customer money without a license, without a credit function, and without a compliance hire. Which is exactly why the second step is the dangerous one. The first step was defensible on the grounds that loyalty access fees are not payments. The second step, whatever form it takes, is where a regulator stops seeing a loyalty program and starts seeing a payment service, and where the float that is currently useful becomes the float that must be segregated. And why is it seductive? Because the interface is already moving that way. In the August 2026 refresh, card management was promoted from a small button in the corner to front and center. That is a product team telling you where its instincts point. When cards become a primary navigation object, somebody eventually asks why one of them is not ours. So the fourth refusal is this. Do not hold customer money beyond what HeyMax First already does, and do not extend HeyMax First's balance until somebody whose job is risk has looked at it. That is not a permanent prohibition. It is a sequencing rule. Become a payments company later, deliberately, with a license and a risk officer and a reason, not gradually, by convenience, one small wallet at a time. I want to close this chapter with the thing that makes refusal genuinely hard here, because I do not want to pretend it is easy. Every one of the 3 refusals is a real business. Cards make money. Bank infrastructure makes money. Ascenda has been doing it for over a decade. Card-linked offers made money for years before they did not. I am not saying these are bad businesses. I am saying they are bad businesses for this company, at this size, with this balance sheet, at this moment. And that distinction is the entire discipline. A strategy that says these ideas are stupid is easy to write and usually wrong. A strategy that says these ideas are good and we still are not doing them is much harder to hold, especially when a user writes in asking for a card for the 100th time. Now, having said what to build and what to refuse, I owe you the least comfortable chapter. What breaks all of this? Chapter 19, What breaks it? Look at 3 dates in the summer of 2026. The 1st of June, cash for miles is terminated and 17 loyalty programs stop being reachable. The 1st of July, the Accor transfer ratio is cut from 1-to-1 down to 3-to-2, a 33% devaluation of the most generous hotel partner on the roster, 4 months after HeyMax had run an uncapped 20% bonus into that same program. The 15th of July, HeyMax begins advancing members up to 1 million miles they have not yet earned. 6 weeks, tighten, devalue, then lend. I do not believe those are 3 unrelated product decisions. I think they are one project, and reading them together is the most important risk assessment anybody can do on this company. Here is the logic. If you are about to extend 1 million miles of credit to a member, you cannot have that member immediately convert those miles into 40 different outside programs at par through a manual workaround you cannot control. You close the leaks first. You tighten the ratios where the currency is leaving too cheaply, and then you lend. That is the classic loyalty playbook, executed competently and quickly. Reduce the currency's value while extending its timing. Every major program in history has done some version of it. And it is precisely the thing that puts every recommendation in this book at risk, because all of them, the long-tail currency sale, the merchant-funded dining product, the agent surface, the points retailing, rest on the same foundation. The promise never expires, 1-to-1, no blackout dates. That promise is not marketing. It is the collateral. A brand pays cash for Max Miles because Max Miles are worth something to its customers. A restaurant funds a reward because a diner values it. A member parks $23,000 in access fees because they trust the currency will still be worth having when they come to spend it. Devalue enough, and every one of those transactions gets repriced against you. And unlike an airline, HeyMax has no aircraft. If people stop believing in the currency, there is nothing underneath it. So let me go through the specific ways this comes apart, in rough order of how much they worry me. The first is credit losses inside HeyMax, first that nobody has modeled. The product has no deadline, no penalty, and no minimum activity. Its only recovery mechanism is the member choosing to keep shopping, and there is no risk roll, no credit roll, no underwriting, collections, or compliance roll posted anywhere at this company. If the repayment behavior turns out worse than assumed, and the honest position is that nobody can know yet because the product is weeks old, then HeyMax has a receivable it cannot collect and a hole it can only fill in one of 2 ways: raise money or devalue. Raising money in that condition is expensive. Devaluing is free, immediate, and destroys the collateral. That is the doom loop, and it is why Chapter 15 ranks staffing risk above building anything new. The second is governance of the currency in other people's hands. Atom repriced Max Miles by 47% in a single step in May 2026, and roughly 75% cumulatively since launch. HeyMax could do nothing. Now imagine the long-tail currency business from Chapter 9 working, 50, 100 brands issuing Max Miles. Every one of them has the same unilateral power, and the perceived value of the currency gets set by whichever partner is currently least generous. The mitigation is contractual, and I named it: rate floors, notice periods, and removal rights. But it has to be in the standard terms from the first customer, because you cannot retrofit governance onto 100 signed agreements. The third is issuer behavior, and this one is entirely outside HeyMax's control. Card issuers in Singapore systematically strip rewards from anything that looks like miles manufacturing. DBS and UOB-issued American Express cards stopped earning on CardUp from the 1st of April 2026. Bank of China's Elite Miles card excluded CardUp and IPMI in June 2025. CardUp itself raised its fee from 2.6% to 2.9% in June 2026, citing higher processing costs. The pattern is consistent. When a route to cheap miles becomes popular enough to notice, an issuer closes it. Any HeyMax product that depends on issuers tolerating an arbitrage has a shelf life, and the shelf life is set by somebody else's product manager. The fourth is concentration, which is the endemic disease of this whole category. Points.com disclosed that 2 loyalty partners accounted for 57% of its revenue, and its top 10 produced 74% of gross profit. Cardlytics disclosed that its top 3 bank partners took more than 80% of partner share, and then watched one of them leave on 90 days' notice. HeyMax's version of this risk is not visible from outside, and that is itself the concern. We do not know what share of the 500 million miles issued annually is funded by chocolate finance. We do not know what share of revenue comes from the top 3 merchants. My guess, and it is only a guess, is that the concentration is high because it always is at this stage. The 5th is capacity, and it is the one I would raise first if I were on the board. 30 to 38 people, 2 live markets, 3 to 5 more promised, a consumer app just rebuilt, a browser extension with 4 more programs to add, a card application affiliate business, 4,700 merchant pages, and 430 programmatic articles to maintain. 4 business-to-business product lines nobody is selling. And a credit product with nobody watching it. That is not a roadmap. That is a list of things that will each receive a fraction of somebody's attention. And the honest reading of the 2 open job advertisements is that HeyMax knows this and has made a bet that artificial intelligence lets a small team carry a load that would previously have required a large one. Support run by agents. Markets opened by configuration. 1 product serving 100 markets. I think that bet is defensible, and I think it is the right one for this company. But it is a bet, it is unproven at scale, and if it is wrong, the failure mode is not dramatic. It is quiet. Things simply stop being maintained. The way the business page has not been touched in 2 years, still advertising 50,000 customers to an audience that cannot buy anything. The 6th risk is the one I can least assess, which is that the claimed numbers do not mean what I have assumed. Everything in this book is built on 150,000 users, 500 million miles, and $6 million US, all company claimed on the same day in January 2026 at a fundraising moment. I have treated them as directionally honest and structurally informative. If the revenue is gross rather than net, or if the miles figure includes issuance the company does not fund, my arithmetic moves. And there is one more data point that gave me pause. HeyMax has stated a target of 1 million users and 2 billion max miles by the end of 2026. Against 150,000 users claimed in January, that is close to a 7-fold increase in 11 months. I do not think that will happen, and I want to be careful about what I mean. Missing an ambitious target is normal and forgivable. What would worry me is the behavior that chasing it produces, because the fastest way to add users in this category is promotional issuance, and promotional issuance is the coupled, margin-destroying thing this entire book has argued against. The 7th and last is the competitive clock, and it is short. Google has written perk awareness into a shopping cart that spans search, Gemini, YouTube, and Gmail. The only reason Chapter 14 is still an opportunity rather than an obituary is that I could find no Southeast Asia launch date for it. That is the risk register. Credit losses, currency governance, issuer behavior, concentration, capacity, the reliability of the claimed numbers, and a very large company moving into the same space. Notice what is not on that list. Nowhere in it is a competitor building a better rewards app. HeyMax's real risks are almost entirely internal or structural. That is usually a good sign about a business, and it is precisely why the plan in Chapter 17 was mostly about charging for things that already exist rather than inventing new ones. Which leaves the verdict, and the number that decides everything. Chapter 20, the verdict and what would change my mind. Here is the answer in one sentence. HeyMax does not need a new idea. It needs to charge for the one it already published, and the job advertisements say it is building exactly the right company to do that and has hired nobody to sell it. Let me earn that sentence. I started this book with an arithmetic problem. 500 million miles issued a year, worth 9 million Singapore dollars at the company's own redemption rate, against $7.7 million of revenue. $60 of value handed to a user who generates 51. Revenue and cost welded together, so that growth scales a thin spread rather than widening it. And I said the question was not how HeyMax gets more users. It was what HeyMax can sell that does not consume a max mile. Then I went looking for the answer, and I found it on a page the company wrote 2 years ago and has not updated since. 4 products. Max Miles Loyalty, rent our currency instead of building yours, with SingSaver already doing exactly that. Affiliate marketing, with Rakuten describing HeyMax as its Asia-Pacific expansion vehicle. Redemption partner, sell your airline's own points to our audience. Employee benefits, put miles into a company's payroll. 4 ways of making money that mostly do not require issuing a mile against a shopping commission, all of them articulated. One of them live with a named customer. And no price, no interface, no documentation, no rate card, no sandbox, no salesperson, 1 contact form. Meanwhile, 3 things I expected to recommend turned out to be closed. The card, because the license costs several $1 million of dead capital in a company that has 11, and because a card earns interchange and issues miles against it, which is the same problem with a regulator attached. Bank infrastructure, because Ascenda has 255 people and DBS and abolished platform fees, and Plusgrade has Singapore Airlines and Cathay, and the ability to write revenue guarantees HeyMax cannot. And horizontal card-linked offers, because Cardlytics ran that experiment in public for 8 years, spent $856 million on acquisitions, wrote off $714 million, and is now worth about $21 million. So the constructive answer is narrower than I expected when I started, and I think that narrowness is the finding. Sell the currency, self-serve, to the long tail that neither incumbent will ever call. Own the dinner table, because it is the one card-linked model with a 20,000 restaurant proof, and HeyMax has already built the merchant graph down to individual outlets. Occupy the agent surface, cheaply and now, because none of the 3 protocol stacks has a loyalty layer, and Google has already written the words, leverages payment perks, into a shopping cart. And switch on points retailing inside FlyAnywhere, because 13 pages already exist and 2 people could make them active in a quarter. Underneath all of it, fix HeyMax first. Price the credit risk, staff it, and say publicly whether access fees are segregated. That is a repair, not a build, and it outranks every new product in this book because it is attached to the promise everything else depends on. Now, there is a deeper reason I am confident about the shape of this answer, and it is the pair of acquisition prints. Points.com sold for about 1 times its revenue. Talon.1 sold to a DN for about 12.5 times. Same industry, 4 years apart. One moved gross transaction flow at a 14% margin and carried the credit risk. The other sold software at software margins and carried none. That is not a story about valuation fashion. That is the market pricing the difference between coupled and decoupled revenue in cash twice. HeyMax is already past the revenue threshold for its next round. What it has to prove is not a number. It is a shape. And here is what I keep coming back to. This is not a company that lacks strategy. Somebody there worked all of this out, wrote it down, and then went back to the consumer app because that was what the Series A required. The strategy has been sitting on HeyMax.ai/business, advertising 50,000 customers for about 2 years. The hard part of strategy is knowing what to sell. They know. What is missing is a rate card, an interface, and the decision to charge. Now, I promised you falsifiers, and this is the part of the book I care most about, because a strategic argument that cannot be broken is not an argument. It is a mood. Here are 5 specific, checkable propositions. Any one of them, if true, changes my ranking. The first would demolish the entire diagnosis. 1. If HeyMax publishes the wholesale price of a max mile, and it is comfortably above 1.8 Singapore cents, then the spread is fat, the coupling problem is small, and the right strategy is not to build anything at all, just sell more miles. My entire diagnosis rests on the inference that the wholesale price sits below the redemption price, and that inference is drawn from arithmetic, not disclosure. Print the number and you settle it. 2. If a majority of the $6 million is already decoupled, if it turns out to be card referral fees, membership and partner-funded issuance rather than shopping commission, then the diagnosis is simply wrong. The company is further along than its own marketing suggests, and the task is to scale what exists rather than to build what does not. 3. If a single anchor signs a deal large enough to change the revenue shape by itself, a bank, an airline, a super app, then portfolio reasoning stops mattering entirely. Do that deal and nothing else. Everything in this book is advice for a company that does not have one big yes. 4. If most of that 500 million miles is partner-funded rather than commission-funded, then the per-user arithmetic in Chapter 1 overstates the problem. The business is healthier than it looks, and the currency wholesale line is not a new recommendation. It is already the business, and the recommendation collapses into do more of what you are doing and say so. 5. If Google's Universal Cart reaches Southeast Asia with working card benefit awareness before HeyMax ships an agent surface, then the third recommendation is dead on arrival and should not be started. Not delayed, not scaled down, not started. Each of those is checkable, most of them by a single disclosure, and I would rather be corrected by one of them than be vaguely right for the wrong reasons. Let me finish where the whole thing has been pointing. There is a company in Singapore that has spent 3 years and $13.6 million building something genuinely difficult. A loyalty currency people trust that never expires, that moves 1-to-1 into 16 airlines, and that redeems against any seat on any airline with no blackout dates. That is the hard part. Airlines took 40 years to build what HeyMax built in 3, and United had to pledge its program to lenders before anyone found out what it was worth. HeyMax has the same kind of asset at a much smaller scale, and it has never once told anybody what a max mile costs. The promise is published, the price is not. Put a number at the bottom of that page, and everything else in this book is just sequencing.